All right. So everyone in the class, all the live people, all the recorded people, welcome to the session. Very good morning. Who all do we have in this live class today? Come on, tell me. Come on. Who all do we have? Yes. So very good morning, everyone. Can you all see me, hear me? Is everything all right? Audio, video, everything seems sorted. What is the status? Someone please tell me. Come on, people. What is the status of audio, video? What is going on? Very good morning. Can you all see me? Jai, very good morning. Is audio, video, everything is proper, sorted? Others in the class, very good morning. So guys, this video is going to be a full English, very comprehensive concept plus question revision video for the topic of advanced capital budgeting decision in CA final AFM. Yes? So before we start the video, let me very quickly tell you a few things. Yes. So who all are there in the class? Come on, live people, say something in the chat box, mark your attendance. Yes. So first in this video, we are going to use two files, two notes. One is the out notes, which is the concepts notes. Another is out scanner, which is the question bank. Our out notes, let me show you, are very uniquely designed notes where all the concepts are being taught in a chart driven manner. Rather than plain text and formula, things are explained to you in terms of tables, timelines, charts that you see here, right? Which makes your learning very easy, your retention for a very longer period, the recollection in the exam very effective, everything works, right? Then is the out scanner. The question bank, which has compilation of all the questions of RTPs, exam papers, MTPs, study material and other institutes publication. So all those have been compiled for you, which is relevant for you, right? This out scanner, as you see, every question has a QR code. For almost all the questions, for most of the questions, you will find that when you scan the QR code, you can watch the video solution of that particular question as many times whenever you want. This is the facility which is there along with the out scanner. These are the same notes which we use for our class students, right? They are available to be freely downloaded by you. They may also be available to be bought in the form of hard copy. Yes, when you want to scan the QR code, let me tell you, it is possible only when you buy a hard copy from us, right? So link for everything. In the description of this video, link of all these notes and everything is there. The last thing before I speak up is that we already have a playlist of all such revision videos like derivative, forex, IRRM, IFM, portfolio, etc. This is advanced capital budgeting decision. We have plans to come up with other topics as well, right? So let's get started. Let me tell you, this video will be sufficient enough for you to clear all your concepts and also solve the practical questions based on those concepts. So are you all ready to gain that confidence in the topic of advanced capital budgeting decisions? Come on. So before we start, if you really want to be that confident, please make sure you like the video, make sure you subscribe the video, right? Subscribe the channel, so that not only the knowledge you can get from me, but also the blessings. Yes. So well, bringing you all to the discussion on advanced capital budgeting. Extremely easy topic. Yes. What this topic involves is extension of what you have learnt at CA inter level, which is calculating NPV and onwards. So before we go on to calculate things, let's make sure that certain basics which you have already learnt in inter are compiled, are recollected by you. So first of all, whenever it comes to capital budgeting decision, all of you should know that it is not the profit of the company that matters to me, it is the cash flow of the company or any project that matters to me, which means the calculation of NPV or IRR or any other thing related to a capital budgeting, right, is primarily calculated on cash flows and not profit. So first is this. Second, you have to realize that opportunity cost is also relevant, right? If there is a benefit which is foregone because of a project that I want to start. For example, I want to start a project, right? I will, to set up that factory, I will not, take any other premise. Someone else's premise I'm not taking because I have my own premise with me, right? If I use that premise, then I won't be able to give that my own premise on rent to someone, which is why I won't be able to earn that rent on the premise if I start to use it. Do you agree that from my pocket there is no outflow which is going if I use my premise, correct? But sir, is there a loss of inflow which will happen if I establish a factory in my own premise? Yes, I will lose that rental. So not earning an income is also a cost. Not having an inflow is also an outflow, is the concept of opportunity cost I wanted to give you. Next, you all should realize that in the question, whenever you start a project, you will not only require the fixed initial investment, you will also require the working capital. That working capital which is considered as an outflow today, irrespective of, even if the question is silent, that is assumed to be as inflow at the end of the project, whatever is the amount of initial outflow on working capital. Fine. Sir, sunk cost you should realize is a dead cost, is not considered for capital budgeting decision. That is something already incurred. Sir, allocated overheads similarly are also sunk cost. Right? I hope you know what allocated overheads are. I'm starting a project, right? There was a cost which was incurred, for example, at management level. Now, since that management cost, the management is also taking care of this project, some proportion of their cost is allocated here. It is not specifically incurred for the project. It was anyways being incurred. For the sake of calculation, it is allocated to my project, which is again irrelevant, is not considered. Right? You should realize that the cash flows and the discounting rate, both of them will be considered as post-tax. That is all we wanted to know. Yes, 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 yes. So everyone in the class, all right. Are you all there? Are you all there? So let us get started, people. Let us get started with the main concept that we gonna understand. Sir, I'll talk about the cash flows later on because I'll have to take you to the basics of AFM and the out notes. I'll take you there. But before that, let's understand it. Sir, we talk about capital budgeting decision, but we ignore the risk involved. Can you please connect it to the portfolio management? There are two shares. One share gives me a higher return, but at a higher risk. At CA inter level, we have talked only about the higher return, higher NPV, but we did not talk about the risk involved in that project, and that is what we have to learn to incorporate now. There are three techniques broadly through which you can do it: statistical, other techniques, conventional. When it comes to statistical, what all do we need to learn? Sir, it is primarily, it is very well relatable to portfolio management. We will learn if you have cash flows and their probabilities, how can we calculate expected cash flow? Similar to if you have possible returns and their probability leads to expected return, very similarly. Using expected cash flow when you calculate NPV, it is called as expected NPV. Similarly, you remember variance and standard deviation, which is fluctuation of possible returns from the expected return. Similarly, here you have to calculate the variation or the deviation or the fluctuation of possible cash flows from the expected cash flow calculated here. You have to just listen to it right now, the exact calculation. I'll take you to the concepts and the question. So, standard deviation variance of the cash flow and of the NPV is what we will learn, and then we'll learn coefficient of variation. So let's get started with the very first thing, which you'll find extremely easy, boss, calculating expected cash flows and expected NPV. I start a project today, right? And how do you denote expected NPV? You can denote it as like this, even in the exam, expected cash flow like this. right? So let's say everyone in the class pay attention, it's really easy. So suppose I want to start a project in which my initial outflow is 10,000. Fine. The project is going to have a life of 3 years. My required rate of return, my discounting rate is 10%. In year 1, I have not been given a particular amount of cash flow that I will make. Similarly for year 2 and 3, I have rather been given the possible cash flow that I would be able to make along with the probability of their occurrence. Which means in year 1, I might receive 5 whose probability is 20. I might receive 4,000, or I might receive 5,000, or I might receive 6,000, the probability of which is this. So if you have the possible cash flows and the probability of their occurrence, then on an average, using statistics on an average, can you tell me how much cash flow are you expected to receive? Sir, 4,000 into 0.2, 5,000 into 0.5 and 6,000 0.3, when you add, it becomes 5,100 as the expected cash flow of year 1. So you have learned to calculate that using probability and possible cash flow, how much cash flow are you expected to receive, you can calculate. Similarly for year 2 and 3, when I calculate expected cash flow, it is 7,200 and 8,900. Now the question has become simplified. Very good morning. Ujjwal, very good morning. All other live and recorded people in the class, very good morning. If you participate, you learn better. You learn more interestingly. Yes. So, sir, now my question to you all is, do you agree that it has now become a simplified question that my initial outflow is this and I'm expected to have the inflow of this, this and this over a period of next 3 years, then what is my NPV? Is it that I will receive sure these cash flows? No. There is uncertainty, the cash flow may be more, may be less, but on an average, I'm expected to receive this. So if you have to calculate the NPV now, can you all do it? Right? Pershik, very good morning. How are you? Very good morning. So if I have to calculate the NPV now, can we do it? Yes, sir. We have future cash inflows. Let's discount the future cash inflows to calculate present value of cash inflow. Let's deduct the present value of cash outflow from it, and what you get is NPV. Sir, these are the cash flows for the next 3 years, where present value factor at the rate of 10% is this. Accordingly, can I say, the present value of future cash flows will be 5,100 into 0.909 is 4,635.9. Similarly, 7,200 into 0.826 is 5,942 and so on. So overall present value, the total present value of all the expected cash flow is 17,267, right? Less initial investment that I'll have to make today is 10,000. So in present value terms, whatever I've earned, right, the expected NPV is 7,267. This is the most basic thing that you do even in C enter level. The point to remember is that Nishchal, very good morning. Very good morning, Nishchal. So I would appreciate that you guys interact, because that is when you learn better. Do you agree, people in the class, that if these are the expected cash flows, then the NPV so calculated will be expected NPV, because it is using this NPV is calculated based on the cash flows which are themselves on an expected basis. This is the first thing done extremely easy. Now you will learn that, sir, how do we calculate the risk, which is the standard deviation and the variance of expected cash flow and the NPV. Yes, boss? So let's calculate. Sir, I will have the cash flow. Let's feel the risk. Let me first tell you that intuitively. People in the class, I'm asking you a question. Please answer it. There are two projects, Project A, Project B. Life is 5 years. For the 5 years, they will have same cash flow. Project A can have an expected cash flow of 4,000 or 6,000 with 50% probability each. Project B can have a possible cash flow. So 4,000 and 6,000 are the possible cash flow with probability. Similarly for Project B, the possible cash flow is 2,000 and 8,000. Again with the probability of 50% each. Do you agree both the projects have expected cash inflow of 5,000 if you realize? 5,000. 4 into 50%, 6 into 50%, similarly 2 into 50 and 8 into 50. The expected cash flow is 5 in both the case. Which project will you choose given a choice? Which project will you guys choose given a choice to choose? Come on, what do you all tell me? Everyone? Do you realize it is project A because it has lower risk, lower deviation of cash flows as compared to project B, which has higher risk because of higher deviation. So did you realize it is not only the cash flow which should be considered for the purpose of decision making, it should also be the risk involved in that cash flow or that project that should be considered. That's what you're going to calculate now. Deviation of the cash flows. Sir, for year 1, let us talk. Sir, for year 1, these are the possible cash flows. Right, probability and the possible cash flow. The expected cash flow I knew is 5100. So let's apply the same thought process as you learn in portfolio management. Dhwani, very good morning. Right, let's apply the same thought process as you read in the portfolio management. How much are these cash flows individually deviating from 5100? So 4000 minus 5100 is 1100 negative, 5000 minus 5100 is 100 negative, 6000 minus 5100 is 900 negative. This is how these individual cash flows are deviating from the expected cash flow of 5100. Do you remember portfolio management, we need the deviation at squared level, and that to average the deviation. 1100 into equal to is this, 100 into equal to is this, 900 into equal to is this. So these will be the deviations of respective possible cash flows at a squared level. How much is the average deviation? How much is the weighted average deviation? Sir, this is the squared level deviation, the probability of which is 0.2. This is the squared level deviation, the probability of which is 0.2. This is 0.5, and this is the squared level deviation, the probability of which is 0.3. Are you all able to please grab the flow of what I'm trying to explain? The rhythm of the solution, not the formula, the rhythm. So the squared level deviation, when done average, I mean with the effect of probability, you get the average squared level deviation, which is nothing people in the class called as variance. Variance is simply the average deviation at squared level of all the possible returns from the expected value of 5100. That's what the variance actually mean to you intuitively, and the same thing you follow even in the portfolio. Yes, boss. So, sir, you try to create the formula. If this is P, this is X, next will be PX, same as portfolio. This is DX, and this is P into DX square. This is actually an ex ante distribution of portfolio management. Yes, so total of it will be summation of P into DX square, which is variance of cash flow of year 1, sigma of cash flow of year 1 at squared level. Perfect. This is 4,90,000. The under root of which will be standard deviation. So you say standard deviation of cash flow of year 1, which is under root of this is rupees 700. Perfect. Whatever you have done for year 1, similarly when you do for year 2 and year 3, not repeating it in the class, it tells you that how much the cash flows are deviating. First year possible cash flow was 5100. Right? Second year is 7200, third year is 8900, but are these cash flows certain? No, they are subject to uncertainty deviation. How much would they on an average deviate? 700, 600 and 700. Can you tell me of year 1, 2 and 3 which year's cash flow is the most risky? Come on, please everyone in the class. Which year's cash flow is the most risky? Tell me. Year 1 700, 2 600, 3 700. Please. Sir, higher the standard deviation, higher the risk. Can I say year A and year C, I mean year 1 and year 3 are the most risky? People, could you all connect? If I could convey to you the risk of the cash flow, then now at least this video deserves a like. Yes, please. Everyone. Perfect. Sir, next, learning to calculate the risk of the NPV. Sir, please apply common sense that this NPV is nothing but present value of inflow minus outflow. Yes, outflow is okay, fixed, certain today, it is at 0 point, but the inflows are uncertain. All these inflows that you were talking about is subject to uncertainty. This can deviate by 700, this by 600, this by also 700. Up and down deviation, the respective amount of deviation. Right, now this deviation, and I'm sure even if you have not liked the video, now at least after this discussion you're gonna like it, because this is how we will learn it, right? So now we have the present value of future cash flows as my NPV. Those future cash flows are subject to deviation, then even the present value is subject to deviation, and which is why my overall NPV is subject to deviation. Let me try to explain that to you in a very simple manner. Sir, for respective year 1, 2 and 3, how much is the amount of deviation? 700, 600 and 700. Do you all agree? Yes. If my cash flows deviate by 700, 600 and 700, do you agree the impact on the NPV of those deviation will not be same? The impact on the NPV will be present value of those deviations, because at the end of third year, if a cash flow deviated by 700, in today's term the deviation will not be that. In today's term, for the sake of NPV, the deviation will be present value of that 700 rupee deviation of year 3. Do you connect to it? So which is why the first thing we're gonna do is to calculate the present value of deviation. First year is 1.1 divided by 1.1 to the power 1. Second is divided by 1.1, the discounting rate, to the power 2. Third cash flows deviation will be discounted for 3 years, 1.1 to the power 3. So these are now the present value of deviation which are going to affect my NPV. Do you agree my NPV is made up of all 3 cash flows? It is summation of all 3 cash flows. So similarly, the deviation in the NPV should also be the summation, the total of deviation of all the cash flow. If first deviated by this, second deviated by this, third deviated by this at present value level, my overall NPV can deviate by sum of all of them. Correct? But please always remember, sir, all these addition, deduction, etc. things happen in statistics at variance level, not a standard deviation level. So you will have to square the present value of SD to convert them to variance. You'll have to square up to convert them to variance. And now if you have the present value, right, if you have the variance, right, at present value level of different years, you can add them up to find out the variance of the overall NPV. Sir, if I square them up and if I then finally add them, I will get the variance of overall NPV, which is nothing but the variance of, which is nothing but the sum of variance of individual years, that too at a present value level. Everyone requesting your responses on this particular thing, please could I explain? Super ultra fast, kindly give me an answer. Sir, how do you calculate it? 700 divided by 1.1 into equal to m plus. 600 divided by 1.1 equal. I mean this particular thing gets solved into equal to m plus. Similarly, 700 divided by 1.1 equal into equal to m plus. Memory recollect, are you people getting 927, 935? 927, 935 is the memory recollect, the under root of which this is variance of NPV. How do you denote it? Sigma, obviously, of NPV, but at 2, at square level, right? A standard deviation of NPV is under root, which is 963.03. Nishal, the answer is yes. Dhwani, the answer is yes. Ujjwal, Purshit, Jai, everyone else in the class, could you get not only the answer, but the rhythm of the thought, the thought process behind it, so that you don't have to mug it up is my point. Now at least, if you people are clear, the way we have learnt it, it was new for you. Then this, finally, the concept, the understanding deserves the like. This is calculating variance in standard deviation. There is one more thing we have to calculate in it, which is coefficient of variation of expected cash flow and expected NPV. Sir, what is this funda now? Let us learn. So everyone in the class, please pay attention. It's gonna be again very basic. What it says, sir, if you have two cash flows, one project give me expected cash flow of 5,000, another project give me expected cash flow of 6,000. Due to higher expected return, right, it has an higher expected risk also. So it has a standard deviation. For example, of 600, it has a standard deviation of, for example, 500. Right? This is expected cash flow, and this is a standard deviation of cash flow. Can you tell me which of the two project is better? Sir, not very directly, because this has a higher cash flow but has a higher risk as well. This has a lower cash flow, has a lower risk as well. You cannot comment. To solve this problem, we have coefficient of variation, which calculate the ratio of risk relative to return. For example, for year 1, how much was my cash flow? In the denominator comes 5100 as my cash flow. Everyone listen to it. In the denominator comes 5100 as cash flow, and the numerator is 700 rupee as the risk. The deviation of the cash flow in the numerator, the cash flow itself in the denominator tells you that 500 that you are expected to earn is subject to the variation of 700 rupee, which means it is subject to 13.73% variation relative to its value. If I am expected to receive 100 rupee, it is subject to deviation by 13.73. The point is really simple. One project has 5,000 rupee cash flow, another project has 1 lakh rupee cash flow. Something whose value is only 5,000 may deviate by 500, but something which has a bigger value, automatically the amount of deviation will also be bigger. So only by comparing 500 and 10,000 we cannot say this is more risky. It's like 10,000 is the deviation on a bigger cash flow of 1 lakh rupee, which is also a 10% deviation, which is also 10% of the amount of cash flow in both the case. Could everyone in the class convey to you the underlying logic behind calculating coefficient of variation? It makes the project with different sizes comparable. So first year, 13.73% is the deviation as an amount of cash flow. Next year, 8.33%, then 7.87%. So please realize, you all told me that, sir, second and third year cash flows are equally risky. 700 and third year is again 700, they are equally risky. But among the two, you will be able to better comment now that with 700 rupee risk, it was giving me 500 cash flow. With 700 rupee risk, it is giving me 8900 cash flow. Can you all feel now connect that in percentage terms, this is the best situation? In fact, let me reverse all your conclusions. You were saying that, sir, where is the thing? Yeah, you were saying that second year's cash flow is less risky than third because of only deviation of 600. But please feel, 600 deviation on a lower amount is 8.33% of your cash flow is subject to deviation. Here 700, but on a higher base, only 7.87% of the cash flow is subject to deviation. Could you realize that coefficient of variation gives you a better conclusion than the standard deviation or the expected cash flows in isolation? Requesting people in the class, your responses on this particular thing kindly validate. Our perception of most risky and least risky changed after we learnt coefficient of variation. Can you all please tell me, in your understanding, coefficient of variation should be lower or higher for a given cash flow or a project? What do you think? Come on everyone in the class. You would want the coefficient of variation to be as high as possible or as low as possible? Let's apply common sense. Let's figure out if you are able to answer this question or not. Lower. Perfect. Sir, what you are doing for cash flow, the same thing you can do at NPV level. Because even for NPV, you have expected NPV and the risk of NPV. I am expected to earn 7267 as NPV. Let me show it here to you. I am expected to earn 7267 as my NPV. The expected NPV you learnt on the very first page. Yes. Yes, sir. Fine. And how much is the risk of NPV? 963.03, the calculation we did, right? of adding individual years variances. Perfect. So 13.25% is the percentage by which my expected NPV is expected to deviate 13.25%. Perfect. As you all are saying, lower is better. That's absolutely correct. The first category, the statistical techniques of incorporating risk in the capital budgeting has been done. Sir, if you realize this was a very comprehensive practical question we have done on this, let's solve one or two more questions of this type. Come on. Come on, people in the class. Let me check. First question is actually same as what we have done. Second is also. Cool. So let's solve question number 5th. People, let's solve question number 5th. Question 1 is exactly same as what we have done. Let's solve question number 5th. Project X, Project Y under evaluation of XY company. The estimated cash flow and the probabilities are as below. Project X, if I talk about, which has an initial investment of 70 lakhs, will have a life of 3 years, which is going to give me the cash flows in the first year like 30, 50, 65, the probability of which is given to me. Then the cash flow can be 30, 40 and 55, the probability of which is given to me. And then 30, 40, 45, the probability is again given to me. There's another project which will have a higher investment of 80 lakhs. Higher investment is there, and the cash flows I will have throughout its life will be 40, 45 and 50 lakhs, right? I mean to say every year I will have the same cash flow, because we have not been given the year-wise cash flow distribution, right? Please observe the difference. Every year I will have this cash flow, the probability of which is 20, 50, 30. In this table, the probabilities are given, horizontally. Now the probabilities have been given vertically, which means same year I'll have these possible cash flows with these probabilities. What is the life? If the life of the two projects are different, they are not comparable. In the absence of information, we have to assume that even this particular project has 3 years of life. Fine, sir. Which project is better based on NPV criteria with a discount rate of 10%? You have to calculate the NPV of the project. Which means, do you agree? NPV of the project is anything that gives me a higher NPV is better. So let's calculate NPV, but before that you will have to calculate for project X the expected cash flow. Using expected cash flow you calculate expected NPV super fast, everyone in the class on your calcs. 30 will be the cash flow has 30% probability, 50 will be the cash flow has 40% probability, 65 will be the cash flow of year 1 has 30% probability. How much is the expected cash flow of year 1? All the live and recorded people, please answer this question. Come on. So it's like 30 into 30 multiplied by 30% M plus, 50 multiplied by 40% M plus, 65 multiplied by 30% M plus, 48.5 being the cash flow of year 1, the expected cash flow of year 1. Similarly for year 2 and year 3, these are the expected cash flow. We did the expected cash flow calculation in the table of NPV itself, that for the next year, people in the class, if we, for the 3 years, if we have these expected cash flow at the rate of 10%, if discounting factors are this, then the present value of future cash flow is 107.28. Are you finding it logical? Present value of expected cash flows. Let me tell you, the presentation that you see here in the out scanner is way better than how has institute presented it. We have not significantly deviated, we have made the presentation better. For example, what they write here may not be standardized and may not look good to you. Now you realize that, okay, the total of present value of expected cash flow is this. Minus the initial outflow of 70 lakhs give me expected NPV of 37.2, it gets done. Similarly, for the second project, it's easy. every year if I have the same cash flow, then rather than present value factor, I can use present value annuity factor. Could you get this line? Annuity factor means, sir, for year 1 to 3, if I have the expected cash flow of 40 multiplied by 20% M plus, 45 multiplied by 50% M plus, 50 multiplied by 30% M plus, 45.5 is the expected cash flow of every year next 3 years. Present value of those 3 cash flows is multiplied by annuity factor, giving me 113.16, minus the outflow of 80 lakhs give me 33.16 as the expected NPV. So in terms of NPV, which one is better? 37.28 is better. Now next, compute the standard deviation of present value distribution. Meaning to say, present value distribution as in net present value that you've calculated, compute the SD of that and analyze the risk. Sir, can I say, to be able to calculate the risk or the standard deviation of the NPV, I will need the standard deviation of these individual cash flows. Let's talk about project X first. The standard deviation of first cash flow is really simple. That tabular thing can be done now with the help of single formula. What were we doing in that table? Deviation of individual possible return 30, 50 and 65 lakhs from the average of 48.5. Look at the formula. X minus X bar, X minus X bar, X minus X bar. How much is 30 deviating from 48.5? This much. How much is 50 deviating from average or expected of 48.5? This much. And similarly, the deviation is 65 minus 48.5. In the first year, I had 3 possible cash flows. Those possible cash flows are deviating from the average value by this much, but I need the deviation at squared level. So this deviation is then squared up, right? And if you need the weighted average deviation at squared level, so will be like this is the squared level deviation, the probability of which is 30. Then I have this as my squared level deviation, the probability of which is 40%. Then I have this squared level deviation, the probability of which is 30%. So how much is the average deviation at squared level of cash flow of year 1? That you tell me. Boss, I don't need the answer of calculator of this equation. I need an answer to, could you understand, the table can be simply consolidated, summarized in this equation if you realize. We can also calculate the standard deviation or variance without creating that table is my question to you all. Come on, tell me. Nishchal is yes, every other student in the class, you have to please respond to this particular thing. Come on. Come on, come on, come on. Could you process that the particular table has been incorporated in this formula, and with this formula you can do it. So let's not solve it in the class right now. Let's accept that when you underroot that variance, it becomes standard deviation. So for year 1, 13.61 is the SD. For year 1, 13.61 is the SD. Similarly for year 2, 9.76 lakhs is the SD. Year 3, 5.94 lakhs is the SD. A student came to me that, sir, there is a confusion. For example, 30 lakhs is there. If I solve it considering 30 lakhs and if I solve it considering 30 lakhs like this, there is a difference in the answer. There won't be any difference at all. You can continue to solve whatever you want. But when I do 30 lakhs, at some point you will have to do square. It will be such a huge number that won't be, able to fit it in your table. So better, if examiner give it to you in lakhs, you continue it in lakhs and do 30 lakhs. Simply, see, 30, 50, 65 lakhs. That's all you have to do. Finally, one thing you all should do, expected NPV after this table, write down in the form of text that 37.28 lakhs rupee. This way, if you write, the possibility that examiner may deduct marks for not writing the amount clearly, he will give you. Anyways, we have put it in the heading over here. Are you understanding? Are you understanding? So now we have the standard deviation of individual years, using which can we calculate the standard deviation of the NPV? Yes. These are going to be the standard deviation of individual years in the coming years. So how much is the SD at present value level divided by discounting rate to the power 1 divided by 1 plus 1.1 to the power 2 divided by 1.1 to the power 3. So I have the present value of standard deviation. I need to add these standard deviations present value to find the overall standard deviation of my NPV. But all the deduction addition happens at variance level, which is why you'll have to first square them up. So you have the squared level deviation, squared level present value deviation of individual years. Adding will give you the variance of the entire NPV, and putting an under root to it will give you the standard deviation of the entire NPV. When you solve it, the answer is 15.43 lakhs. I'm saying when you do it at home, don't revise, don't revise it as a formula, revise it at a flow, as a flow which I've taught to you. Please solve it in the class right now and give me the answer of how much is the standard deviation of project X, NPV of project X. Super fast, everyone in the class waiting for your answers. Come on. Come on, come on, come on. All the live people, all the recorded people, let's see what's going on. Come on. Yes, people, are you facing any buffering or anything? Please tell me. Yes. So what it says, sir, the answer when you solve it at your own entirely on the calculator, you should be able to do it. We have learnt it in the class that this is into equal to m plus, then this into equal to m plus, then this into equal to m plus. Then you do memory recollect will be the addition of all three of them, and when you press under root it will be 15.43 lakhs. I hope we guys are done. Yes, are you all able to connect? Come on. Yes, sir. Next is calculating NPV of project Y, for which we need to calculate the calculating standard deviation of NPV of project Y. But before that, we need the standard deviation of cash flow. Sir, these are the possible cash flow where expected is 45.5. So possible cash flows minus the expected cash flow at a squared level, that too with the effect of probability of 20, 50 and 30%, you get the, and when you under root it finally you get the standard deviation of cash flows of every year as 3.5 lakhs. For the next 3 years, since I have the same distribution of cash flows, I'll have the same standard deviation of 3.5 lakhs every year. What is the present value of those future standard deviation? 3.5 divided by 1.1 to the power 1 to the power 2 and to the power 3 respectively. This is the present value of standard deviations. My NPV is made up of all three cash flows. So NPV can deviate by deviation of all three cash flows. So let's add them up, but at squared level. First you square up, then you add up, you have the variance of the NPV. When you under root, you have the standard deviation of NPV as 5.03 lakhs. So first you had to comment from the perspective of risk, return, then you have to comment from the perspective of risk. Sir, which one has a lower risk? 15.13 versus 5.03 gives me project Y is less risky than project X. Sir, are these conclusions correct? Ideally no, because they have even different NPVs practically thinking. Higher NPV, higher risk, lower NPV, lower risk. But since the institute, right, specifically talks to analyze the inherent risk, we have not talked about it. Which means preferably the coefficient of variation is calculated when the institute asks for it. Question number 5th, people in the class, gets done. Question number 5th, people in the class, gets done. Just give me a minute. Fourth question, if you observe, they specifically talk about calculating coefficient of variation. So an easy one, frankly, to be done. So we are, I think, now done with this, right? So one, understanding comprehensive in the outnotes we have taken. Another one is solving a practical question we have done. Are you people comfortable with this? Can I take you all to the next discussion? Sir, next is learning other techniques, and in the other techniques we will, so let me show it to you here. Wait, we are done with this. Now we are learning in other techniques, and in which we will first of all start with this scenario analysis, then we do sensitivity analysis, and then we go to the third techniques. Sir, these last two techniques is of almost zero practical question relevance. Fine, has got no relevance from practical question point of view based on the questions of the study material so far. Perfect. So let's learn scenario analysis now. Scenario analysis, people in the class, is here. It says you have to evaluate individual scenarios that a project can have. For example, sir, I have to invest in a project 50,000 rupee. The 10% discounting rate is there for my project. In the best case, the project will give me the cash flow of 30. In the base case, it will give me annual cash flow of 25. In the worst case, it can give me 20,000 cash flow. In the best case, the project can have a life of 4 years. In the base and the worst case, the project can have a life of 3 years. For example, they say compute the NPV of project under different scenarios. Imagine that I have also been given the probability of them. Suppose I have been given the probability. Don't calculate the expected cash flow where 30 will be the cash flow has 30% chance, 25 will be the cash flow has 45% chance. No. Don't calculate the expected cash flow. Rather, what do? Sir, rather than this, first calculate the NPV individually, independently of each of these scenarios. For example, if this is the cash flow for the next 4 years, then what will be the present value of cash flow? 30,000 into annuity factor for 4 years at the rate of 10%. Present value of cash flow is 95,100. If this is the cash flow in the base case, 25,000, then the present value of future cash flow will be present value factor at the rate of 10% for 3 years, giving me the present value as 62,175. Similarly, 20,000 is the worst case present value, worst case cash flow multiplied by a factor of 3 years, give me 49,740 as the present value of inflow. In these three different scenarios, these are going to be the three present value of future cash flows. Yes, next. If the initial outflow is 15, all three of them, the NPV is 4, 5, 100, 12, 175 and 260, 2 positive and 1 negative NPV. In the best case, I'll have this. In the base case, I'll have this. In the worst case, I'll have this NPV. You can evaluate individual case wise that which is the best case, which is the worst case, and so on. This is how scenario analysis works. Yes. Which means, do you agree? These are the possible NPVs you can have. The probability of which is 30, 45 and 25%. So if you have the possible NPVs with its probability, can you have the expected NPV, which is X bar? If possible NPV is X, the expected NPV would be X bar. People in the class, are you all able to connect to what I'm saying? Rather than doing the average of cash flow, then calculating NPV, we will now first calculate NPV and then do its average to find out the expected NPV. The reason is really simple. For every scenario, I would want to know my NPVs separately. Requesting your responses, how much out of 10 could I convey this particular thing to you? Please, please, please. How much out of 10 are you people comfortable on this? Come on, tell me. So, can I tell you that this is the NPV with this probability, NPV with this probability, give you the expected NPV of how much? 18944 on a rounded off basis. This is what examiner may ask. The next and really interesting part which the examiner may ask is the probability of occurrence of the best cash flow or the worst cash flow. Let's imagine a situation, two possibilities. Let's for now assume that life of, even in the best case, life is 3 years. Just for this concept, let's assume it. Sir, in the first year, if I have 30,000 cash flow, right? Then in the second year, is it compulsory that I will continue to have 30? Or in the second year I can have 25, 20 or 30, anything. Similarly, then in the third year I can have 30, 25, 20, anything. It depends. What are you assuming the cash flows to be? If the cash flows of all 3 years are considered independent, then it means in the first year if you have 30, then in the second year there is a possibility you can have any of them. Then similarly in the third year you can have any of them. This is independent cash flow. Then you have dependent cash flow, that in the first year if it is 30, this is independent and this is dependent, that in the first year if it is 30, then 100% in the second year it will be 30, and in the third year again it will be 30. This is 100% sure. So if the examiner asks you what is the probability of achieving best case, what is the probability of generating this NPV of 45,100? Sir, answer in both the scenarios will be different. Why? If it is dependent cash flow scenario, life is easy. That there is a 30% chance that cash flow in the first year will be 30,000. Agreed? Cash flow of first year will be 30, has 30% chance. If the cash flow of first year is 30, then in the second year there is 100% chance that cash flow will be 30, and again 100% chance that the cash flow will be 30. So overall possibility of generating 30,000 every year continue to remain 30% only. Logic in case of dependent. However, if the cash flows are independent, then what do we say? We say that in the first year the cash flow will be 30,000, has 30% chance. In the second year, I have only again 30% probability to get 30,000, because in the second year there are other two cash flows as well which I can generate, which have the possibility of 45 and 25%, right? So in the first year I get 30,000 as 30% chance. Of that 30%, I will have only 30% chance to generate 30,000 even in the second year, because I may generate something else as well. And similarly, of that 30% chance will be the chance of generating 30,000 in the third year. Can you please connect this particular thing, that if the cash flows are independent, the probability of generating 30,000 in all 3 years, the joint probability will be 30% into 30%, and into only 30% of that will be the joint probability. Requesting your response. 30 multiplied by 30% multiplied by 30% is only 2.7% overall probability of generating 45,100 if the cash flows are independent. I'll give you a very easy example to explain this concept again. Sir, imagine that you are here. There is 40% chance that you clear CA foundation, and 60% chance you won't clear. If you clear, then only you go to inter, and there is 50% chance of clearing inter and 50% chance of not clearing it. You stand here. If I ask you what is the probability of clearing C inter, so you will say 40% chance if I do it, and in that 40 again only 50% chance of clearing C inter. So overall probability of clearing C inter from here is 40% into 50% means only 20% chance of me clearing C inter, 80% chance that I'll be stuck somewhere in the between. Could you understand what I said? Joint probability, the probability of occurrence of both the events. Yes? Could you understand it? Similarly, if you clear foundation, then there is 100% chance, suppose that you will clear inter. So if I ask you what is the probability of you clearing inter, sir, 40 into 100% is 40%. That is not the case in case of independent. Two events are independent. Yes, that is what we have done in this case, and that's how we have calculated the probabilities of cash flows being dependent or independent. Sir, if I have all possible NPVs, listen to me, the last concept before I go ahead. If I have all possible NPVs and the probability of the NPV, I calculate expected NPV. Using possible NPV and expected NPV, can I also calculate the standard deviation of NPV? The answer is yes. Nishal says, sir, this became personal. I know, because only when it becomes personal, you are able to connect it more. Yes. Sir, if I have the possible NPVs and the probability, and if I have the expected NPV, can I calculate the standard deviation of expected NPV? Really easy. Sir, this will be the NPV. This is the possible NPV which deviates from expected NPV by what amount? 4500 minus 18944. But how much will be the deviation at squared level? This. And what is the probability of its occurrence? Into 0.3 plus. This will be the deviation. This is the expected NPV which is deviating from the average by this amount. Right? At squared level, this is the deviation, the probability of which is 45%. Then 260 minus 18944 is the deviation at squared level with 25% probability. This gives me the variance of NPV, under root of which everyone in the class is the standard deviation, which is 178.34. The NPV, which is 18944, can deviate by 178.34. The coefficient of variation can also be calculated for that, which is an NPV can deviate by 94% of its value. If I am expected to earn 100 rupee, that can deviate by 94 rupee is what my conclusion is. Yes. Can you all please realize the thought process for scenario analysis is somewhere in the flow for the previous things that we have done. Sir, only difference is here you first calculate NPV and of respective scenario and then proceed ahead to calculate the expected NPV or the standard deviation of NPV. Everyone in the class, the formula approach that we had learnt here has been applied, if you all observe. This was scenario analysis. Let's solve the practical question of this type. Wait. So let's solve question number 8, question number 7 for that, right? Really a great question, a comprehensive question that we're gonna solve. Come on, just give me a second, let me have water, then we all continue. Give me a minute. So people in the class, let's get started to understand this question, question number 7th. Following are the estimates for net cash flow and the probability of the new project of Messrs X Limited. Sir, I have a new project whose initial investment will be 4 lakh, whatever be the scenario. After tax cash flow will be for the next 5 years will be either 1 or 1.1 or 1.2 lakhs. The probability of which is given to me. The salvage value is estimated to be 20, 50 and 60,000. The probability is again given. Required rate of return 10%, calculate expected NPV. You all might think that which approach of calculation of NPV should be followed. There are two approaches now. Approach number one that you learnt in the first section, that sir, if I have possible cash flows with the probability, first I calculate expected cash flow of year 1 and then 2 then 3. Using expected cash flow you calculate expected NPV. Option 2, using these possible cash flow, first you calculate possible NPVs, and of the possible NPV you calculate expected NPV, which you have learnt in the topic of scenario analysis. Sir, it's best to figure out first the question belong to which category. As you read the question ahead, they talk about the best case and the worst case and so on. Do you agree that if you first calculate the expected cash flow, then you will not have individual case-wise NPV? That is only possible when you calculate individual scenario-wise NPV, and then you are able to comment which is the best or the worst, which is why what approach will we need to follow? First calculate individual possible NPV and then calculate expected out of it, so that in the coming questions you can directly comment which is the best and the worst. Could I convey this? Right? So I will have to, for that, take you all to the solution. The outscanner solution is not what I'm saying. I hope I'm able to find the solution in the handmade notes for question number 7. Hold on for a minute. Derivative, foreign exchange, where is the advanced capital budgeting, boss? Question number 7th, right? Seventh. Please look at the solution of this question. Sir, I need to find out the expected NPV, for which I will first find out the individual possible NPVs. Sir, if the probability is 0.3, cash flow per annum will be 1 lakh, probability 0.5, cash flow per annum is 1.1 lakh, with 20% probability cash flow per annum is 1.2 lakhs. Of all these future cash flows, what is the present value at the rate of 10% for 5 years? This is the factor. Present value of annual inflow is 379, 417 and 454, 4,54,000. Simple. Similarly, the salvage value in respective case is going to be this. The present value of salvage value is going to be 12, 420, 31050 and 372. So overall present value of all future cash inflows, including the annual inflow and the salvage value, is this plus this, is this plus this and this plus this, minus the initial outflow, which in all cases 4 lakhs. When you deduct 4 lakhs from it, you get A plus B minus C as your NPV. Annual inflow plus salvage inflow minus the initial outflow, all at present value level, is negative this, then this, then this. When they ask you, these are my possible NPVs, if you realize, these are my possible NPVs. And with the probability of 0.3, 0.5 and 0.2, the expected NPV is 39922. Sir, if you follow this approach, the answer is going to be same. Which approach? Where you first do the expected cash flow. That 1 lakh will be the cash flow has 30% chance, this cash flow 30% chance, this cash flow has 30% chance. The expected cash flow is 1,09,000. Then you calculate NPV, answer is same. But this one is preferred whenever it is scenario analysis. This is preferred. Cool. Next, sir, they ask you what is the best and the worst case NPV. Are you observing? We can directly tell them now which is the best and which is the best. Sir, best is 92180, worst is 8480. Without additional effort, this job gets done. Third is, what is the probability of occurrence of the worst case if they are perfectly dependent, if the cash flows are dependent and independent. Sir, worst case. If the cash flows are dependent, it means in the first year if the cash flow turns out to be 1 lakh, then every year it will continue to be 1 lakh sure shot. So there is 30% chance of it being 1 lakh in year 1, and then every year 1 lakh has 100% chance. So overall probability of occurrence of worst case in case of dependent, it is 30%. Logical. But if the cash flows are independent, meaning to say in the first year, if it is 30, try to feel what I'm saying. In the first year, sir, there is only 30% chance of I getting 1 lakh. Then in the next year, I again have 3 possibility in which 1 lakh is only 30%. Then again in the next year, I have 3 possibility getting 30% in the third year, getting 1 lakh in the third year has only 30% chance. So 30 into 30 into 30 for 5 cash flow give me 30% to the power 5 or 0.3 to the power 5, which is nothing but 0.243% as the probability of getting that worst case of NPV of 8480. This is slightly illogical that if you observe there are not 5, there are rather 6 cash flows in total. Sir, why? Because there is a possibility that 5 year you get 1 lakh, but in the salvage value you get 60,000 as the salvage value. This is not the worst case. The worst case happens when in the 5 year you get 1 lakh and in the 5th year you get 20,000 of salvage value, which should also be considered for probability. So it is 0.3 into 0.3, not 5 times, but also for the salvage value 6th time in my opinion, which institute has missed it. Boss, please, on this particular part number C, I need your validation. How much out of 10 could I explain this part to you all? How much out of 10 are you people? Please settle on this question so far. Requesting your super fast responses. Come on. Come on. Come on. What do you all say? Quick. What do you all say? Settled are we? Sir, next part examiner are asking. Next part it is asking, sir, what is the standard deviation coefficient, assuming there are only 3 streams of cash flow which are represented by each column for the table given below. Please understand what they say. Sir, a standard deviation and coefficient of variation. Do you agree? Of what? Of obviously NPV. Do you people agree now that standard deviation of NPV can be calculated in 2 ways? Possibility 1, individual cash flows NPV, which you have learnt here. Let me show you. Possibility 1 of calculating standard deviation of NPV is this, where you have individual cash flows standard deviation, and using this formula you calculate NPV's standard deviation, right? Option 2. Option 2 is what you have learnt in the scenario analysis, that sir, NPV's standard deviation does not require individual cash flows standard deviation. What do you rather need is individual possible NPV and expected NPV and their probability. So you can find the deviation of individual possible NPV from the expected like this, and you need the probability. You can directly calculate a standard deviation of NPV. Could you all connect to what I'm trying to explain? There are 2 ways to do it now. Now observe what the question is saying. Question says a standard deviation you have to calculate assuming that there are only 3 streams of cash flow represented by each column. This is one possibility of generating cash flow. This is another possibility of generating cash flow. This is third possibility of generating cash flow. So this is a hint that you will have to first calculate NPV of respective scenario and then calculate the standard deviation of those NPV with the effect of probability. That is what examiner is saying, that follow the approach that you have learnt in the scenario analysis, sir, which is why we are picking those questions which can add maximum value to your knowledge, to your learning. Perfect? Could you process the language? Sir, so let's say NPV is negative 8480. This possible NPV deviate from 39922 by what? Negative 8480 x minus x bar. Similarly 48060 minus x bar. Similarly 92180 minus x bar. So how much is the deviation at squared level? This is the deviation. What is the probability of occurrence of that squared level deviation? 0.3, then 0.5 and 0.3. How can again be 0.3? Must be 0.2 na? 0.2, sorry, 0.2. So this gives you automatically, adding the variance, the under root of which is a standard deviation. When you solve it, you get 35807 as under root. So NPV, which is 39,000, the expected NPV, which is 39,000, can deviate by 35807, which in percentage terms give you the deviation of 89.69%. People in the class, that is covariance of NPV, which is D part of this question gets done. The last part really easy. I would request you all to do it at your own. The last part, do it at your own, really easy. It says that rather than discounting rate, make the discounting rate 9% or 11%, change it by 1% for some reason. This last part you will have to do at your own. Now give me a minute, let me check the status. There is one more possibility of question that I can teach to you, right? 19th question. The objective will not be discussing the entire question. The objective rather will be explaining only the flow or the rhythm of that question. Are we all ready to learn the new question? People in the class, please tell me. Come on. Are you all ready? Something I was trying to explain, that there are two possibilities to calculate NPV. The same thing has been there. The firm has investment proposal requiring 80,000 of outflow. The investment is expected to have 2 years of life. Year 1, 40% chance that cash flow will be 50 and 60% chance cash flow will be 60. So 50,000, 60,000 can be the cash flow in year 1, right? Having 40 and 60% chance, right? Then in year 2, the cash flows and the probability depends on what has been the cash flow in year 1. In year 1, if it is 50, then in year 2, it will be 24, 32 and 44,000 with these probability. In year 1, if it is 60, then cash flow will be 40, 50 and 60 with this probability. So depending upon the cash flow of 1 year will decide the cash flows of year 2. In year 2, year 1, if I have higher cash flows, then 2 will have automatically higher cash flows. Fine, cool. 10% discounting rate, construct a decision tree. This is what I have constructed as the decision tree. 80,000 is the initial outflow today. In year 1, feel the timeline. Year 0, 80,000 initial outflow. Year 1, 40 and 60% chance of cash flow being 50 and 60. And in year 2, right, 24, 32 and 44 will be the cash flow with probability this in case of this cash flow. Similarly, in year 1, if it is 60, then year 2, it will be 40, 50 and 60 with this cash flow. Construct a decision tree and calculate expected NPV. Expected NPV you have to calculate. Sir, now I am confused which approach I have to follow. First, should I calculate the expected cash flow? For example, these are the cash flow with this probability. This is the expected cash flow. Similarly, these are the cash flows with the probability. Give me expected cash flow, and expected cash flow give me expected NPV. The answer is no. Why? Because again it talks about the worst case and the best case probability, which means you should have the NPV of individual case. Sir, this is a particular case, this is a particular case that 0 year I pay 80, first year I receive 50, second year I receive 20, this is a particular case, this is a particular path. Then 0 year I pay 80, second year I receive 50, 0 year I pay 80, first year I receive 50, second year I receive 32, this is a second path. So using these 6 possible paths, you have to calculate 6 possible NPVs is what you have to do, and then calculate expected NPV. Could you feel? Could you feel? So what is the possible NPV? 24,000 into the factor of 2 years as 0.2826 plus 50,000, 0.909 being the factor of 1 year, minus 80,000. That way if you calculate, the possible NPV is 147.26. The possible NPV. The probability of which, observe the probability. Do you agree the probability of receiving these cash flows is 40% chance of receiving 50, and if I receive 50, then further only 20% chance of receiving 24. So 40 into 20%, people in the class give me 8% of getting NPV, which is there in the path 1, which is calling it to be NPV 1. Possible NPV 1 I will receive has only 8% chance if you observe. Requesting people in the class your responses, could you connect these, this is the decision tree, with the joint probability of its occurrence being this. So if I have these possible NPVs, right, and if I have the probability of their occurrence, probability into possible NPV give you expected NPV of 6223.76. Possible NPVs into probability is 6223.76 is the answer. All the live people, all the recorded people, are you all able to connect? Yes sir, gets done. Second part. Worst case NPV, best case NPV, all that then is easy. Just wanted to explain you this particular thing in question number 19. The scenario analysis question gets done. Yes boss? Perfect. Sir, next. Next. So let me tell you one particular thing, really important. There is a possibility. What is the possibility? Listen to me. There is a possibility that you all might find the question sequence for advanced capital budgeting to be really different from what you see in the video. So frankly saying, let me tell you, for all other chapters the sequence is really set. For advanced capital budgeting, the questions are actually all jumbled up. For instance, scenario analysis questions are questions 6, 7, 8, 19, 20. You are right now watching this video where in the outscanner 19th question is what we have done. When I create the further versions of outscanner, I might rectify and bring all these questions to the sequence. For example, 19th question. Okay, just one second. For example, 19th question that you see here, I might change that question to question 9th in the next version of outscanner. So maybe you are watching this video after a year and you have an updated version of the outscanner where the sequence of this question may not match. Kindly put some effort, but you'll be able to find this particular question in your outscanner is the point. This problem is not there with any other chapter that is all already uploaded. Only for this particular chapter you will have to manage. Now I'm taking you all to the next concept, which is learning sensitivity analysis. A really brilliant and interesting thing to learn sensitivity analysis. People in the class, please pay attention. When we calculate NPV, the NPV is calculated using different variables, different parameters. For example, imagine that I've been given the details of sales price per unit as ₹50. Sir, from the sales price per unit, if you deduct variable cost per unit, you get the contribution per unit. So sales price per unit minus variable cost per unit is contribution per unit. Multiplied by number of units give me total contribution. Deducting fixed cost and depreciation give me profit before tax. Deducting the tax give me profit after tax. To the PAT, If you add back depreciation, you get CFAT, and to CFAT, when you multiply the annuity factor, you get the present value of cash inflow. Deducting the outflow gives you NPV. This is how you calculate NPV. Agreed. The same calculation which you have learnt here can also be presented in equation, and the equation is what you actually need to present for better understanding. Right. Sir, how will the equation look like? The equation will look like, so equation is like sales price minus cost price. Automatically give you the contribution per unit, multiplied by number of unit, give me total contribution, minus fixed cost minus depreciation, sorry, this bracket, curly bracket, minus fixed cost depreciation, give me PBT, multiplying it 1 minus T, give me PAT. To this entire number, to the PAT, when you add back depreciation, you get CFAT. And to CFAT, if you multiply present value annuity factor, it is called as NPV. So this equational presentation of it is an easier, is preferable for sensitivity analysis. Now what is sensitivity analysis? Let me tell you. So imagine that I've been given the data that initial cost is this, sales price is this, unit sold is this, fixed cost is this, and the life is 3 years and 10 years. Life of the project is 3-year, discounting rate 10 year. Accordingly, I tried to calculate NPV. Let's do it. Let's do it in terms of equation. Sir, sales price minus, suppose there is no per unit cost. Suppose there is no per unit cost. So sales price is the contribution itself multiplied by the unit sold, give me the total contribution minus fixed cost of 40. So sales price multiplied by number of unit, give me total country minus fixed cost, give me the PBT, profit before tax. Sir, why not depreciation? Let me also teach you one more thing. What is the purpose of depreciation? That you deduct it so that PBT become lower, so that when you charge tax, you pay a lower tax, and then you add back the same amount of depreciation, so that cash flow again increases. If there is no tax rate given in the question, then there is no point of deducting depreciation, adding the same number back, because there is no tax advantage that you can take on depreciation. Depreciation is not a cash outflow, but you get a tax benefit, which is why you first deduct it, calculate tax and add back. But do you realize if there is no tax rate, you will deduct the same amount and add back the same amount, and it won't affect my, PBT or PAT here, because there is no tax rate. So if there is no tax rate, you can ignore depreciation, which is why it has been ignored. So no depreciation deducted. The PBT multiplied by 1 minus T will be PAT, ignored, because there is no tax. Since depreciation was not deducted initially, it has not been added back, now ignored, giving me CFAT, multiplying it with the present value factor, give me present value of cash inflow minus the outflow, give me NPV, the same amount of NPV. Now what is sensitivity analysis? Finally, I'm going to teach you. People in the class, please listen to me. If these variables like selling price, like sales unit, like the fixed cost, like the initial cost, if these variables will change, will my NPV change? Obviously, sir. If all of them change by 10%, for example, will the 10% change in each one of them change the NPV equally? Meaning to say, in the first case, I changed the sales price by 10%, then NPV will change. In the second case, sales price remain 50 only, but the units change by 10%, NPV will change. Then in the third case, this two remain the same, but the fixed cost change by 10%, then NPV will change. Question is, in all these scenarios, will the change in NPV be same due to same 10% change in these variables? The answer is no. So we want to find out to which variable of all these variables, among all these variables, to which particular variable NPV is most sensitive. NPV will change by the most percentage if the same percentage change is applied to these variables. That is sensitivity analysis. The way to solve it is really simple. Actually, there are two alternatives. First I'll teach alternative 1, then I'll teach alternative 2. Alternative 1. Assume a particular percentage change in adverse direction. Sir, sales price, if increases, is favorable to the company. When is it adverse to the company? When it goes down. The number of unit is adverse to the company when it goes down. The fixed cost is adverse to the company when it increases. Let's assume 10% adverse change in each one of them and calculate NPV again. For example, sales price 10% adverse change is 45 rupee. So let's calculate NPV 45 into 2000 quantity minus 40,000 cost into the annuity factor minus the initial cost of 1 lakh rupee give me NPV of 24,330. So let's check. Due to 10% change in the sales price, how much has been the change in NPV? Sir, from 49 to 20, the NPV has become 24,330 with 350, which in percentage terms is 50.53% negative. Meaning to say, due to 10% change, adverse change in the sales price, the NPV has changed 50.53% adversely. It is sensitive. Let's check it for another factor. Let's say it is fixed cost. Let's do it for fixed cost. Right, fixed cost. Sir, fixed cost which is 40,000, which 10% adverse change, it become 44,000. Increase, adverse is increase, yes. So 50, the initial original sales price multiplied with the original quantity minus the increased fixed cost multiplied by annuity factor, my initial cost give me NPV of 39,272. From the NPV of 49, the NPV has become, people in the class, where is that? 39,272. How much is the percentage change in NPV? 20.21%. Can I say? Due to 10% adverse change in the fixed cost, the NPV has changed by 20.21. Right? This is the sensitivity. So which of the two factors is more sensitive? Sales price or the fixed cost? Sir, sales price. The same 10% change in the sales price affect the NPV by 53%, whereas that 10% change in fixed cost affected only by 20.21%, which is why my project is more sensitive to change in sales price as compared to fixed cost. Could you understand it? People in the class requesting your responses. The question solving for sensitivity analysis could I explain to you all. I need a validation, everyone. This was alternative 1. But I am going to teach you alternative 2, which is preferable in the exam, which is more logical, right? Which is actually equally logical but preferable in exam. Dhwani, Nishchal, are you all set? Other live people sitting in the class, are you all please set with what you are learning? Alternative 2, let me explain. Just give me a second. Let me have water, please, before. Yes, boss, there. Come on. Cool, perfect. So let's get ahead. So, in the second scenario, what do we assume? we say that right now this is my NPV. Right now this is my NPV, correct? If I want to make my NPV 0, how much should the sales price be? That is what I want to calculate. I will say if I want to make my NPV 0, then how much should the sales price be? That I will have to reverse calculate, and after that reverse calculation, what is the thought process I will teach you? Just make the calculation once. So I will say let the sales price at the NPV of 0 be S. So what is the equation? 0 NPV is equal to initial outflow of 1 lakh rupees plus the present value of inflow. What is the present value of inflow? Whatever is the sales price multiplied by my 2000 units minus the initial cost of fixed cost of 4 lakh rupee whole multiplied by the annuity factor. So to make the NPV 0, how much should the sales price be? Let's solve this equation and calculate the sales price be 40.10. When I see that from the sales price of 50, which it was initially, right, to make NPV 0, right, sales price of 50 will change to 40.10 and it can make my NPV 0. It can make my NPV 0, meaning to say, sir, it is another way to think the sensitivity that a percentage change of 19.8% from 50 when something changes to 40.10. From 50 when something changes to 40.10 in percentage terms, it is 19.8%. What is the interpretation? A 19.8% inverse change in sales price can make my NPV 0. In other words, can make 100% negative change in NPV. Changing something by 100% negatively is 0. Boss, you are having suppose 65 marks in AFM. What if your marks deduct by 100%? 65, 100% of that is 65 only. If I deduct 65 marks, it becomes 0. So 100% change in marks is making it 0. So 19.8% change in sales will make 100% change in NPV will make it 0. Similarly, the alternative 2, let's apply for fixed cost. That how much should the fixed cost be to make NPV 0? So 0 is equal to negative 1 lakh initial outflow plus the present value of future cash inflows, in which 50 units for 50 sales price for 2000 units minus the fixed cost that I don't know, I need to calculate, multiplied by the annuity factor. When you calculate the fixed cost is 59,791. The fixed cost, which was initially 40k, has to increase to 59,791 if you want to really make the NPV 0, which means in percentage terms it is 49.48%. What do we want to say? We say that to make NPV 0 or to change the NPV by 100%, the fixed cost will have to increase by 49.48%. Think otherwise. A 49.48% in the increase in the fixed cost will make NPV 0, whereas only and only a 19.8% change in the sales price will make my NPV 0. Can you feel that my project is more sensitive to change in sales price, because a smaller change in sales price making the NPV 0, whereas a bigger change in the fixed cost is making NPV 0. Conclusion ultimately will remain the same. The way to present and the calculate it is different. Could I convey to you alternative 2? Now let me tell you what is the situation. The situation is alternative 1 has a scope of assumption. You have to assume a particular percentage change, for example 10%, 5%, 15%. That what if the sale change by 10%? The same percentage change you apply every year, everywhere. For example, if the number of units change by 10%, what happens? If the fixed cost change by 10%, what happens? In the first alternative, you need an assumption. In the second alternative, there is no assumption needed. To make NPV 0, how much should the sales price be? To make NPV 0, how much should the number of units be? How much should the fixed cost be? How much should the initial cost be? Which means alternative 2, every student in the exam hall should have the same solution, which is why this is preferable. Only if the examiner give you change of variables in percentage terms, then apply alternative 1. Otherwise, apply alternative 2 only. That is what we have learnt. People in the class, let's go to a practical question of this type. Let's solve the first practical question of this category as question number 9th. Let me observe what has 9, 10, 11 and 12. Give me a minute. Let's solve first question as question number 9. Cool. Come on. X Limited is considering the following project as per following estimate. Super fast, everyone in the class, please pay attention. Initial cost is 10 lakh rupee, sales price per unit cost is 60 and 40, sales volume for the next 3 years is this. Sir, no fixed cost, discounting rate 10%, you are required to calculate sensitivity of the project. Needless to mention, sensitivity of the project means sensitivity of NPV of the project with respect to sales price and everything. Let's change each parameter one by one. If there is no tax, then there is no depreciation on the initial cost which should be considered. Do you agree? Since there is no tax, then no depreciation is needed to be considered on the initial cost. That is what I wanted to explain. Sir, has that thing been written anywhere? It's important, otherwise how will you revise it? In question number 12. Wait. So anyways, live people, remember to write it anywhere along with the question somewhere. Recorded people, you pause this video, write it down right now. Right, live people, please be back. Let's start with the solution of it. Right, just write down a simple thing that when there is no tax, there is no point of adding depreciation, deducting depreciation and adding it back. You end up writing down at your own. Come on. Sir, which alternative should we follow? Alternative 1, a particular percentage change for all the parameters. Alternative 2, back calculate the parameters such that the NPV becomes 0. Sir, let's first calculate the simple NPV. The base NPV. So base NPV is 60 minus 40 being the contribution per unit multiplied by number of unit of first year, 20,000 being the total country, minus fixed cost not there, minus depreciation not needed, minus tax not there, adding back depreciation not needed. Fine. Sir, if I have different unit for different years, which means I will have different cash flows of every year. So let me discount them manually at the rate of 10%. The discounting rate is divided by 1.1 to the power 1. Next year, 60 minus 40 multiplied by 30,000 unit divided by 1.1 to the power 2. Third year again to the power 3. These are the present value of future cash inflow minus the initial outflow of 10 lakh give me 3,10,293 as my base NPV. Now I will have to check that to change this NPV to 0, how much should the sales price be? Then to make the NPV 0, how much should the cost price be? How much should the quantity be? That's what the approach we're gonna follow, starting with the sales price. Boss, can you all do this calculation? To make NPV 0, the sales price be negative 1 lakh as initial outflow. Sir, you create the base equation because later on the same equation helps you to simply replace a variable. S minus 40 into 20,000, S minus 40 into 20,000, S minus 40 into 30,000, S minus 40 into 30, right? Sir, how do we solve it in the exam? Really easy. Can I calculate can I take S minus 40 as common? Can I take out S minus 40 as a common number and solve this particular part which have been marked red and add them up? So it is like 20,000 divided by 1.1 m plus 30,000 divided by 1.1 equal m plus, and again 30,000 divided by 1.1 equal m plus. Memory recollect is 65 65514, right? So 1 lakh, let me take to another side, so it become positive 1 lakh, whole divided by 65 something, right? give me this. So 1.52 something is the number. So S minus 40, S minus 40, 1 second. So there is a small calculation mistake. Let's not, the objective is I didn't want to waste time doing the calculation in the class that you can practice at your own. The objective is to focus on things which you cannot do, which is understanding and explaining. Yes. When you try to solve it, I'm just trying to give you a way to solve it. 1 lakh comes to the left, it becomes positive number. S minus 40, you take out as a common number. Sir, that multiplied by adding 20k divided by 1.1 plus 30k divided by 1.1 square plus 30k divided by 1.1 cube. Whatever you get, you send it here to the denominator. You send it here in the denominator. Oh, I'm getting the correct answer. Sorry. So 15.26 is equal to S minus 40. 15.26 is S minus 40. So S is equal to 40 plus 15.26, which is 55.26 being the selling price. What do we say? To make the NPV 0, selling price should fall from 60 to 55.26. Think otherwise. Percentage change in the selling price is 7.9%, which can make my NPV 0. Similarly, let's do it for unit cost. Sir, unit cost, let's assume the cost to be C. Right? You solve it, right? So from the cost of 40, perfect. The initial cost, which was 40, to make the NPV 0, how much should the cost be? Sir, 60 minus 15.26. 44.74 on a rounded off basis should the initial cost be. Again, you solve it the same way. 60 minus C, you take common. So what is left in the bracket is present value of 20, present value of 30 and present value of 30, you add them up. This 10 lakhs you take it to the LHS so that it become positive. This 10 lakhs divided by sum of these present values you take, and 60 minus C will be the number on your calci. People in the class, on this particular thing I want your response. Am I able to convey to you how do I do it directly on the calci? This is the same approach we have been following in the class for this. So kindly respond. Super fast everyone, waiting for your response. Please. Come on. I seek your validation. What do you all say? So what happens? The cost when you back calculate is 44.74. Yes. Can I say the percentage change in the cost is 11.85%, meaning to say 11.85% increase in the cost will make my NPV 0, whereas sales 7.9% change will make NPV 0. Yes. So what we are more sensitive to? We are more sensitive to sales. Similarly, sales volume you can do. Sir, let's assume the sales volume to be X. Now there is a point of understanding. Sales price and sales cost is same every year. You can assume it. Volume is changing every year, which is the point of learning. So if I assume the volume of first year to be V, 20,000 to be V, then next year it is 1.5V and 1.5V. Because 30,000 is 1.5 times of 20,000. If 20,000 is V, then 30,000 is 1.5V. And V 1.5V, 1.5V is what you will have to take here. So 60 minus 40 into X, 1.5X, 1.5X. Rather than V, they have considered it as X. Right? So to make the NPV 0, how much should the sales volume be? In the first year, it should be 150 to 63. So how much is the percentage in the volume? Sir, from 20 it became 50. It should become 52 to 63, which means 23.68% negative change in the volume will make NPV 0. So we are not that sensitive to volume as compared to sales price and cost. Similarly, initial outflow you have to do at your own. The last one that I am going to do is part number E, which is the project life, which is a bit different and which is a bit different, right, and is the point of learning. So please focus on this particular part. How do we do it in case of project life? Because please observe, you cannot assume the project life to be X. Imagine this is the equation. Imagine this is your original equation. Can you assume life to be X? like it'll be x, x, x. Is it working? How do you assume life to be x? How do you solve it? You cannot first of all assume it to be x. So what is the way to solve is really easy. First you calculate the present value of cash flow of 1 year. I have to think that I need to make NPV 0. So using the present value of cash flow of 1 year, am I able to recover the initial cost? Similarly, using the present value of cash flow of second year also, with 1 and 2 year, how much cost I am able to recover? Similarly, we will figure out that how much cash flow of third year is needed to recover the cost. Whatever I spoke, let me execute it so that you understand it better. Sir, present value of cash flow of 1 year is this, present value of cash flow of 2 years is this. 60 minus 40 into 20k divided by 1.1, 60 minus 40 into 30k divided by 1.1 square. The initial outflow is 10 lakhs as we know. So the negative NPV is 140495, meaning to say 1,40,495. Using the cash flows of 2 years, out of 10 lakhs, I am able to recover significant value of the cash flow, significant value of initial outflow. Only 1,40,495 I could not recover. If I calculate the present value of cash flow of third year, it is 60 minus 40 into 30 divided by 1.1 to the power 3, it is 4,50,789. I have to calculate that to make the NPV 0, how much should the life of the project be? Right now, with 2 years annual cash inflow, my NPV is negative 1,40,000. If I add the cash flow of third year to it as it is, the NPV become positive. So I don't need the entire year's cash flow of year 3. But I need some proportion of it. Can you all please apply common sense and tell me that 4,50,000 is being earned in the entire year, if in present value terms. If I want to earn only 1,40,000 out of it, because I want to make my NPV 0, not make it positive, how much time of the year I need for that? So sir, if 450 is being earned in the entire year, then 140 will be earned in what part? So it will be 0.31 years. So can I say in 2.31 years in total, I'll be able to make my NPV 0. Sir, rather than 3 years, which was my original life, to make the NPV 0, the life should be 2.31 years, which is 23% change if you observe. So, if 23% change, people in the class, if 23% change in the life of the project can make NPV 0, then the project is still not as sensitive as it was there with the sales price, and the cost price is what you have to interpret. Could you observe how do we do it for sales? How do we do it for life? Alternative 1 is not possible here. In case of project life, alternative 1 is not possible. Only alternative 2 is possible, and that too this way. People in the class, requesting your response. Please tell me. First you calculate with 1 or 2 years cash flow present value, how much is the NPV. Then figure out that for the third year, how much of the entire year, what proportion of the year I need, right, to make the NPV 0, that proportion that you calculate, and the total years is 2.31. Then waiting people in the class for your responses, then only I'll be able to go ahead. Come on. And then calculating percentage change in the overall life to make NPV 0, giving you a sense of sensitivity, giving you an idea or the interpretation of sensitivity. People, this particular question on sensitivity gets done. Cool. That is now the done. Question 10th is extremely easy, right, which is this. Question 11 is, I would say, a difficult level question. Solving it in this video will mislead the video. I want to cover more in less time. So this particular question will mislead you, but you must learn it, right? And question 12th is an easy question. Only a point of learning I want to tell you, right, in this question. Question 12 says the acceptable level of risk is 20%. I mean to say, it is a scenario analysis mixed sensitivity analysis. You do sensitivity analysis is fine. They say that you'll be able to understand in the question when you do. Right now the point is, they say if the economy is poor, normal and good, annual sales units will be this. And the probability of which is this. When we solve the NPV for different scenario, we see that when the units are 175, right, the NPV is actually turning out to be negative. When the units are least, in the poor case, when the units are 175, the NPV is turning out to be negative. The probability of which is 30%. However, we can accept only 20% chances of having negative NPV. What is the interpretation? Acceptable level of risk is 20%. We are ready to have 20% chance that the NPV is negative, but 80% chance should be there that the NPV is positive. But practically, when we went to the market, we realized that there is a 30% chance of negative NPV and only 70% chance of positive NPV, which is why we say the project should not be accepted. This was the only point of learning in this particular question. Rest all it is easy. Question number 12 on Unnat Limited, I wanted to tell you. Yes, boss. This completes the discussion on the sensitivity analysis. So we are now done with scenario analysis as well as we are done with the sensitivity analysis. The next category is easiest among all, which is conventional techniques, boss. Conventional techniques. People in the class, please look at this. Simulation and decision tree, as I said, will not, there's no practical question from institute side on this. We will now learn in the conventional technique, one is risk adjusted, another certainty equivalent approach. Extremely easy, let's discuss it. Then we'll talk about real versus nominal cash flow, which is a part of, advanced capital budgeting. Then we go for a break. After we come from the break, we have 3 to 4 more topics to learn, and then this video will get over. Perfect. So sir, certainty equivalent approach and risk adjusted discounting rate. You look at this. Sir, risk adjusted discounting rate is a common sense. It says, if you remember for the basics, the discounting rate for any project, any share, any bond is its required rate of return. That how much you require to earn from that project, from that share, from that bond. Agreed, sir. How much you require to earn depends on the risk which is involved. Higher risk it is, higher rate of return you want. That is what they say. That if you want to incorporate risk in a project, while evaluating different projects, identify the risk involved. If the risk is more, evaluate it at a higher rate, and automatically the effect of risk has been given, and then you can choose whichever project has the highest NPV. Project A has higher discounting rate. Project B, because of lower risk, has lower discounting rate. Then calculate NPV. Do you agree the effect of risk has been incorporated in NPV? Yes. Now after that, whatever is the higher NPV, choose it. Simple. Yes. Sir, risk adjusted discounting rate is a normal discounting rate, plus if there is a risk premium because of higher risk, you add it. That discounting rate is the adjusted one using which you calculate NPV, on which we have practical questions. Question number 15 and 16, which are really easy. 15, extremely easy. In fact, 16 is also there. Let's solve 16 just out of randomness, because that seems to be a bit more, advanced, bit more. Suppose there are 3 projects, P1, P2, P3. The cost involved is 15, 11, 19 lakhs. The inflow for the next 4 years for respective project are given to us. The risk index is 1.8, 1 and 0.6. Sir, what do you mean by risk index? In this question, they have assumed risk index to be beta. Sir, what kind of beta? Let me tell you. The minimum required rate of return is 15%, right? And the applicable tax rate is 40%. The risk-free rate is 10%. So please let me tell you, RF is 10%. 15% minimum required rate of return is like required rate of return from market, it is RM. That if we have the risk index of 1, then which is the beta of 1, which is the risk equal to market, then the return I need is 15. However, if my project risk index is 1.8, 0.6, 0.1, my required rate of return as per CAPM will be RF plus beta into RM minus RF. For example, in the first case, if risk index is 1.8, the required rate of return, the discounting rate will be 15 minus 10 into 1.8 plus 10, which is 19%. Similarly, 15 and 13%. So I have to now calculate simply the NPV of 3 projects, where cash flows, for example, in the first case is 6 lakhs, the same cash flow. So its annuity multiplied by 19% annuity factor, I get present value of cash inflow, minus initial outflow of 15 lakhs, I get NPV. Similarly, discounting rate here will be 15 and 13. Since the cash flows of every year are different, we can't do annuity, we'll have to do individual years manual discounting. After doing that manual discounting, you calculate NPV. Project C, the third project, is the best because it has highest NPV. I hope I am able to convey to you this simple question 16. It was so simple that there was absolutely no need of solving it in the class or looking at the steps of this in the class. The next concept is certainty equivalent approach, where my cash flows are given, but the cash flows has uncertainty. You can convert those cash flow to a lower cash flow which is certain. You can give the effect of risk in those cash flows, like 40,000 is the initial outflow, which is fine, which is 100% certain, so certainty equivalent coefficient is 1. Then in the first year I will have 20,000 inflow. In the first year I have 20,000 inflow. The certainty equivalent coefficient is 0.9, meaning to say 20,000 I will receive has kind of 90% chance only. So it is like receiving 18,000 with 100% possibility. Converting is risky cash flow is 20,000 with certainty equivalent cash flow, right, is 0.9 coefficient. So cash flow, an equivalent amount of cash flow which will be certain is only 18,000. So basically the objective is convert all these risky cash flows to certain cash flows, risk-free cash flow, after multiplying the certainty equivalent coefficient. Once you have the risk-free cash flow, use a risk-free discounting rate to discount those risk-free cash flows and calculate NPV. Out here in the risk-adjusted discounting rate, cash flow was risky, so the discounting rate also you converted risky by adding risk premium. In the second approach, you made the cash flow risk-free, so the discounting rate being used was also risk-free, and that's how you calculate NPV. Sir, for this particular thing, we have a question number 14, which is extremely easy. These are the cash flows, right? These are the cash flows. The initial outflow is 850 and 825, life is 3 years. Do you agree the cash flows are risky? Even if we calculate NPV, we won't be able to comment which one is better. This cash flow having certainty equivalent coefficient as 0.8, 0.7, 0.5, it has 0.9, 0.8, 0.7, which means these cash flows are more certain, less risky. This cash flows are less certain, more risky. 0.8, 0.7, 0.5 is a lower level of confidence, lower level of certainty as compared to 0.9, 0.8, 0.7. Fine. Sir, in equivalent basis, on an equivalent basis, how much are my certain cash flow? 450, 5 and 5 when multiplied by these factors give me 360, 350 and 250 lakhs as my adjusted cash flow. When discounted at a risk-free rate of 6%, it gives me the present value of 860 minus 850 initial cost give me NPV as 10,980. In the second case, NPV is 1,71,000. So project B, second project, which is project N, is a better project. That simple is the solution to question number 14. Right? As per risk adjusted method, second part is really important. As per risk adjusted method, which project will be appraised with a higher rate? Do you agree due to lower certainty equivalent factor, we feel it has a higher risk, and due to higher risk, due to lower certainty equivalent factor, we see that this one has a higher risk, which is why it is less certain, more uncertain, more risk. More risk means more discounting factor. Project M would be discounted at a higher rate because it has a higher risk. That is what you will have to say to the examiner in 14th question part B. So you people are now clear with all three techniques of incorporating, all three category of techniques of incorporating risk to the calculation of NPV, of incorporating risk while evaluating a project. The next section, people in the class, you're gonna learn now is real and nominal cash flows and real and nominal discounting rates, for which I'll take you to the basics of AFM. So in the outnotes in the initial pages, we have the basics where we compile all our learnings, basic learnings at one place. Sir, fine. Calculation of CFAT, we are now clear with that we have PAT, and adding depreciation to the PAT give me CFAT. How do you calculate PAT is really easy. Sales price minus variable cost, number of unit give me total contribution, minus depreciation fixed cost give me PBT, minus tax give me PAT. Adding DEP will give me CFAT. Now that CFAT that you calculate, right, can be real versus nominal. What do you mean? Let's imagine that I'm trying to predict the future. I'm a company, I'm trying to predict that I will sell 100, 110, 120 and 140 units of my product from year 0 to year 3. 0 year is the actual number, 1 to 3 are the production. Right now price per unit in the market is 200. With the effect of inflation in the coming year, the actual prices in the actual world are going to be 220, 242 and 266. Sir, assuming 10% inflation. So 200 and plus 10% is 220 plus 10% 242 plus 10% 266.2. Fine. However, if we ignore inflation, at today's inflation level, the prices are expected to remain 200, 200 and 200 obviously. If I ask you what will be my actual cash inflows of year 1, 2 and 3, it will be like 110 unit into 220 price per unit. These are going to be my actual cash inflow 1 multiplied by 3 for the next 3 years. These actual cash inflows, which would be based on the actual prices of respective year, listen to my line carefully, these actual cash inflows which are based on the actual prices of those respective point, which includes the effect of inflation in it, are nominal cash flow. However, if we calculate the cash flows not based on the actual prices of those year end, but rather the price of today excluding the effect of inflation, which is 1 multiplied by 2 are the real cash flow. So 110 multiplied by 200, which is for example 2,20,000, I'm just guessing, or 22,000, whatever it is the real cash flow, where 220 into 110, 220 multiplied by 110 is 24,200 is a nominal cash flow. Sir, point is, if the cash flow is nominal, it includes the effect of inflation in it, then the discounting rate to discount that cash flow should also be nominal. If you remember, the required rate of return, which is the discounting rate, has 3 components: real risk-free rate, inflation premium and risk premium. Real risk-free rate and inflation premium collectively become nominal risk-free rate, and nominal risk-free rate plus the risk premium is nominal risky required rate of return. Agreed? In our discussion right now, risk premium is not the concern. Risk premium may be there, may not be there, is not the concern. Our concern is inflation premium. So we say that if the cash flows are nominal, the discounting rate will also be nominal. The discounting rate will include the effect of inflation premium in it, because the cash flows also include the effect of inflation. If the cash flows are real, does not include inflation effect, then the discounting rate to discount those cash flows will also be real, will not include inflation effect, right? What is the relationship between nominal cash flow and real cash flow is important to know. After that, we can immediately go to the practical question. So let's learn it. Sir, nominal cash flow of any particular year can be calculated using real cash flow of that particular year. For example, second year real cash flow is 120 into 200. 200 is the real cash flow, which is 24,000. How can I calculate the nominal cash flow of that year? So 1 plus inflation to the power n into 1 plus 10% inflation. For how many years? Sir, since I want the cash flow of second year as nominal, I will take the cash flow of second year, the real, and give the effect of inflation for 2 years. So plus 10% is 29,040. How do I calculate it? 120 into 242. 120 quantity, 242 price, 29040 is calculating the nominal using real. Or it can also work otherwise. If I have nominal, if I have inflation, I can back calculate the real cash flow. Sir, similarly for rate. Rate is a per annum number, has nothing to do with the number of years. So 1 plus nominal rate in percentage terms is 1 plus real rate into 1 plus inflation premium in percentage terms. Yes. So the relationship between the real rate and the inflation rate is not additive, it is multiplicative. If real rate is 5, inflation premium is 3, it is not 5 plus 3, 8. It is rather 1.05 into 1.03 minus 1 as my nominal rate of return. If the examiner is silent, the rate and the cash flows for the entire AFM are always assumed nominal, whether it is advanced capital budgeting or it is forex or anything else. Yes, only when they say it is real, it is assumed real, otherwise it is always actual cash flow of that particular point, which automatically includes the effect of inflation, which is obviously nominal. Could I convey to you the 10 out of 10 clarity on the basics that I was trying to discuss? Everyone in the class, please respond to me on this. Please respond to me on this. Ujjwala asked me a question that, sir, institute. I will answer your question, Ujjwal. Just a second. I'll answer your question. Answer to your question is yes, Ujjwal, in fact. Okay, let me not repeat that. Boss, everyone in the class, could I convey these basics to you? So based on which there are some practical questions, let's solve them. Yes, question number 17 and 18th are actually the question which belong to this category. Question number 17 and 18. Let's solve 18th question, which is relatively a more advanced question in the class. Sir, KLM requires 15 lakhs for a project. Life 3 years, salvage value nil, depreciation 5 lakh per annum. Fine, given below are the revenue and cost, excluding debt, ignoring inflation, meaning to say they are real, right? So revenue in real terms, we have cost in real terms for the next 3 years. We have tax rate 35, cost of capital 14%. If they don't say anything, that is nominal. If they specify, then it is fine. Nominal cost of capital 14. You have to calculate the NPV. Please tell me if the inflation rates for the next 3 years for revenue and cost are given, calculate NPV. Option 1, convert the rate of discounting to real because cash flows are real. Option 2, convert these cash flows to nominal because rate is nominal. What will you do? Do you agree? For inflation, I don't have a single rate. Do I have a single rate of inflation using which I can convert this nominal discounting rate to real discounting rate? No. Cash flow, the revenue inflation is different, cost inflation is different, and that too for different year it is different. What did you understand? What did you understand? We understood that we understood that sir, cash flows will have to be adjusted. So 10 lakhs being the cash flow of 1 year will be adjusted for 9% for 1 year into 1.09. Second year cash flow, observe 13 lakh into 1.09 inflating it by 1 year into 1.08 inflating it for second year will give me the nominal cash flow of second year. Similarly, 14 lakhs into 1.09, 1.08 and 1.06 inflating it for 3 years, boss. Inflating it for 3 years. Similarly, inflate the cost. So if you have revenue nominal, cost nominal minus depreciation nominal. Sir, how do you know that depreciation is nominal, boss? Really interesting. Do you agree if I spend 15 lakhs today? Think accounting. You debit your cost for 15 lakhs. What is the amount for which you credit it every year? Sir, 15 lakhs divided by 3. The actual depreciation of every year will be 5 lakhs only. It is not that 15 lakhs is today's cost. The depreciation will practically increase, actually increase, and I am just showing it 5 lakhs without inflation. No. It is actually going to be in the actual world only 5 lakhs. It is based on the inflation of that day. The actual number is 5 lakh, which is why it is nominal, right? 555 nominal depreciation deduct, you get PBT. You have a tax rate, you get PAT, you add back depreciation to calculate CFAT, multiplying present value factor will give me present value of inflow, deducting outflow will give you NPV. The solution after learning, after calculating, the solution after calculating the nominal revenue and cost was really easy. Before revenue and cost, we had to do this discussion. Question 18th, people in the class gets done. Could you understand? So now after this category getting done, just a second. We have to move to the next and very interesting and recent favorite of institutes category, replacement decision, which I can commit, will explain to you with such clarity, then it will simplify even the toughest question for you. Question 20, replacement decision concept we're gonna do, but that is after a break. So let's take a 20-minute break, right? We'll have to take a break because it is, or let's take a 15-minute break. 12:21 it is right now. Let's meet back at 12:35. Then we all continue with this. Okay. So see all people after 15 minutes. Cool. 12:35. Then continue it. Please be back after the break. Bye bye. Yes, boss. Are you all there? People in the class, please back. Come on, come on, come on, come on, come on. Everyone in the class, back, 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 please. Boliye. Speak up. So, we gonna now go to the next section of capital budgeting, which is replacement decision. In this category, we need to learn two things. Replacement of existing machine, which means whether we should replace an existing machine or existing business or existing setup or not. Second is optimum replacement cycle, which means when is the best time to replace something. What are the two things, people in the class? First, whether I should replace or not, or when is the best time. First of all, learning replacement, whether we should replace or not. The thought process in this situation is to calculate incremental NPV. And how do you ultimately calculate incremental NPV has a very simple approach, has a very simple thought process. So please pay attention to what I say. At this point where I stand, I had been doing a business using an existing machine. So if I look at my past, I had an existing machine which I'm using right now. Now at this point, I have two choices, two independent choices. Choice 1, continue to use the old machine. Choice 2, sell the old machine, buy the new machine and use that new machine. Are you clear with the two choices? These are, imagine yourself standing here, imagine yourself facing these two independent practical world choices. Continue the old machine because you already have it, use it for the next 5 years. Option 2, sell this machine, buy the new machine and use that new machine for the next 5 years. These are two independent choices you have. First, imagine this choice. If I continue this machine, what is the initial outflow? What are the annual inflows? What is the terminal inflow? Three category of inflow: initial, annual, terminal. Similarly, if I sell this machine, sell the old one, buy the new one, continue to use the new one, in this alternative, as per this alternative, what is the initial outflow? What are the annual inflows? What is the terminal inflow? Once you have the inflows and outflows of both of this alternative, then you calculate incremental. Meaning to say, this is the old machine. If I use, these will be the inflows and terminal inflow will be nothing. Because when I sell the old machine, I will not have any terminal value or salvage value received. Sir, next. Alternative 2 is selling the old, buying the new machine. Right? This will have some inflows and outflows. Then you have to calculate as compared to alternative 1, which is use the old machine. If I take alternative 2, which means sell the old and buy the new, as compared to alternative 1, in alternative 2, how much is incremental initial outflow? I have to calculate incremental in three parts: initial, every year, annual and then terminal. So as compared to alternative 1 and alternative 2, how much is the incremental initial outflow? Every year if I talk about, as compared to alternative 1, how much is alternative 2's incremental inflow? And then terminally if I talk about, as compared to alternative 1, alternative 2, how much is the incremental terminal value? If I calculate the NPV of incremental outflow and incremental inflows, the answer so arrived is incremental NPV, right? And if it is positive, we say replace the machine. If it is negative, we say don't replace the machine. So this incremental approach first involves thinking of two alternatives independently. Don't think any opportunity cost that if we do this, then we won't be able to do this. No, no, no. Think it simple. This is option 1, this is option 2. At a point, you can do only one thing. So when you go here, think everything related to here. When you go here, think everything related to here. And then ultimately compare one with the another to find out how much is incremental. That is the approach, simple approach. Sir, this NPV is not only telling me whether second alternative is good or not. It is rather telling me over and above alternative 1, it is good or not. Beyond alternative 1, it is good or not. Is it better than alternative 1 or not? Overall, it may be a positive NPV alternative. But I don't only want to earn 1 lakh is not my point. 30 I was anyways earning. So if I spend outflow of 2 lakh extra, what I am earning every year is only 70,000 extra. Are you realizing? So point right now is not considering 1 lakh as my inflow. Point right now is considering over and above 30 how much you are earning 70. For that how much have you spent extra 2 lakh. So common sense is incremental tells you extra that went out is this, extra that came in is this. So how much is the NPV of that extra inflow outflow? That is replacement decision. Could I very well convey to you the entire thing, everyone in the class? Please tell me. Come on, waiting for your responses. People. There is a really great question asked by the institute in the recent attempts, November 24, etc. attempts. But I think before that, let me take you to solve a basic question on that first of all, which is question number 27. Come on. Super fast, everyone in the class, question number 27. A company named Robbie's Cube decided to replace an existing computer, right? Original cost of the system was 25. When I purchased it, it was 25. I have nothing to do with that cost. It is sunk to me. It was installed 5 years ago. Current market value of old system is 5. Depreciation of the old system was charged with a life of 10 years. Can you tell me, when I purchased with the estimated salvage value of nil, I purchased for 25,000 a computer 10 years ago. I was depreciating it with I'm repeating my line. I purchased a computer system 5 years ago at a price of 25,000. Fine. I am now planning to replace it. Can you tell me at this point, since I charged depreciation with 10-year mindset, how much will be the book value of that? Sir, half of the depreciation using SLM has been applied because life of 5 years has passed away out of 10, right? So accordingly, per year depreciation, 25,000 divided by 10 is 2500. For 5 years, it is 12,500. Out of total value of 25,000, if the value of 12,500 has been depreciated, the book value now is 12,500. Sir, why are you calculating book value? I will tell you everything. Fine. Depreciation on the new system will charged over the 5 years. That new system which I purchased, whose cost is 50,000, life is 5,000, 5 years. Meaning to say, if you continue the old computer, life is 5. If you sell the old, buy the new computer, life will be 5, so that they become comparable. Fine. Increase in sales with new system is 10% per year based on the original amount of rupee 1 lakh. What is the benefit of buying a new computer? It will increase my sales by 10% per year. It will increase my sales by 10,000 rupee every year. Fine. Company follows SLM, cost 10%, tax rate 30, should be replaced. Sir, common sense. Common sense. Think with me independently. I can bet this question will be the most simplified question of the entire chapter. Sir, option 1, if I continue the old machine, will anything go out of my pocket today? No. I already have a machine purchased 5 years back. Today I don't have to do anything. I just have to continue to use it. Initial outflow 0. If alternative 1. Alternative 2, first initial outflow buy the computer for 50. Second, when I sell the old computer today, I will be able to sell it for 5,000. So 50,000, where is that? 50,000 initial outflow to buy the new computer. Right? But before buying the new computer, what was my second alternative? Was my second alternative only buying the new? No, it was selling the old and then buying the new. When I sell the old computer, I receive 5,000 as the selling price. There is one more adjustment here which is regarding tax. Sir, book value of the computer being sold at a price of 5,000 is 12,500. So 12,500 minus 5,000 gives me 7,500. As the capital loss which I have made. On that capital loss at the rate of 30%, which is 2250, I will have a tax benefit On capital gain, if I pay tax, so on capital loss, I have a tax benefit of 2250. So I will receive 5,000 cash. I will receive the tax benefit of 2250 and I will pay 50,000 in alternative 2. So 42,750 is overall net outflow I will have to make. In alternative 1, no outflow. Alternative 2, entirely 42,750 alternate outflow. Incremental outflow is 42,750. Sorted? Fine. Now let us talk about incremental inflow. Sir, every year, I will have savings of 10,000 rupee, sir, which is fine. Savings of 10,000, right? One line we missed, estimated cost saving of new system will be 5,000 per year. Estimated. So I'm really sorry, I missed to read a line. I'll read that again. The present cost of the new system that we bought was 50. Estimated salvage value of new system will be 1000. The new system that you purchased for 50 will have 1000 value. Estimated cost of new system, it's cost saving as compared to old. When you use the new system as compared to old, the incremental saving is 5000. Do you agree? Automatically that incremental number is given. So increase in sell 1 lakh into 10%, 10,000. Savings in the cost is 5,000. So do you agree that these are the two advantages that I have? Cool. As compared to old, how much in the new will be the amount of depreciation? How much will be the incremental debt? So first let's think debt here, then think debt here, then we get incremental debt. Sir, how did you know we have to talk about debt? Let me explain it to you. Boss, you have to realize generally what is the formula of CFAT? Sir, revenue minus cost minus depreciation give you PBT, minus tax give you PAT, plus depreciation give you CFAT. So if I have to calculate incremental CFAT, take everything incremental. How much extra revenue, how much extra cost, give me extra profit, minus extra depreciation, give me extra PBT, minus 1 my T give you into 1 minus T give me extra PAT, plus incremental depreciation give me extra or incremental CFAT. When you take everything incremental in the same equation, it become incremental CFAT. So similarly, sir, in this case if you observe, revenue 10,000 extra, saving 5,000 extra, so overall 15,000 of benefit. Any other cost information? No. What is the next element? Depreciation. If I use this machine, depreciation is 20,000 divided by 10 as 2500. However, if I use the new machine, sir, 50,000 minus salvage value of 1,000, so 49,000 basically divided by 5. So 49,000 divided by 5 is 9800 minus 2500 give me 7300 of incremental debt. As compared to this, if I go to this option, I save 10, I save 5. I earn extra 10, I save extra 5, but depreciation extra incurred is 7100. So overall extra PBT or incremental PBT will be 15 minus 7300 is 7700. On this incremental PBT, how much incremental tax will you pay? Sir, multiplied by 30% is this. So incremental PAT is 5390. But I have to work on the cash number, so adding back depreciation give me 12,690 as incremental CFAT that I will generate here. Could you understand this? People in the class, kindly respond to this particular thing once. Everyone in the class, please respond to this particular thing and tell me if you are settled or not. Come on. So I am now clear with my annual cash flows. Let me think about the salvage. If I use the old, this will generate nothing finally. But if I use the new, this will generate how much salvage? 1000. So incremental, people in the class, is 1000 is what I will generate. So incremental salvage is 1000, terminal is 1000. So ultimately, initial incremental outflow 42,750. Annual incremental inflow for the next 5 years is 12,690 and terminal incremental is 1000. So if I have the incremental inflows, outflows, if I have the present value factor, the incremental NPV is positive, we should replace the machine is the answer. Please From every single student sitting here, please tell me, could I convey this entire question to you with clarity, with ease? Come on, tell me. Come on. Requesting your responses in the class, please tell me. Please. Waiting for your responses for me all to proceed ahead. So I have a request to make to all the students watching this. If you really feel that the video has helped you, video is helping you out, please put down your genuine feedbacks, your genuine comment in the comment section of this video. So that it helps me, it motivates me to create more such videos. There's a lot of scope to do now. There's a scope to come up with super 100 questions, for example. There's a scope to solve RTPs, MTPs or new questions by ACI in English. There's a scope to come up with English marathon. A lot of things can be done. It is your involvement in this made me realize how much do you want. Yes. So whatever are your genuine feedbacks, please put down in the comment section of this video. Yes. So anyways, question number 27th gets done. Another question, I'll just give you a sense of it. We won't solve it entirely. I'll just give you a sense of it. Question number 22, please look at this. What happens? Yes. So in this case, what they say is that I have an old machine. To the old machine, I have two choices to do. Scenario 1, upgrade the machine. So old versus upgrade is scenario 1. Scenario 2 is old versus new. Old versus new. So you have to think replacement only, but you have to think twice. First, you say option 1 is continue to use the old. Option 2 is upgrade. So when you do it, how much is the incremental initial outflow? How much are the incremental annual inflow? And how much is incremental salvage value? That is scenario 1. Scenario 2. In scenario 2, in the second situation, we say option 1, continue the old. Option 2, sell the old and buy the new. This is entire alternative 2 of scenario 2. So again, for both these scenarios, how much is the initial outflow, incremental annual inflow, incremental salvage will give you the incremental cash inflows, outflows. For both of these scenarios, we calculate incremental NPV. And then we say which of the two scenarios is better as compared to existing upgrade or as compared to existing buy the new. That is how question number 22 is, right? So the presentation again by the study in the study minute of this particular question is really ambiguous. It's not simplified. We have simplified the solution. Answer will match 100%. Absolutely no doubt. And marks will also be secured, no doubt. Perfect. So first, if we upgrade, examiner, let's read the question. I will explain it, not solve it for you. The company has a machine, old machine, 0 book value. It can be sold for 50. Company is thinking to choose one of the two. Incur additional cost of 10, upgrade the machine, right? Incur cost of 20 lakhs plus 50,000 and buy the new machine. Useful life 5 years in all the cases, salvage value 0. Expected PAT of 3 alternative given. If you continue the old, this is the PAT. If you upgrade the machine, this is the PAT. If you buy the new machine, this is the PAT. 40% tax rate, assume SLM 15% cost, what will you do? Option 1, if I use the old, what is my initial outflow? Scenario 1, old versus upgradation. If I continue to use the old, initial outflow no, but if I upgrade, initial outflow 10 lakhs. So incremental outflow overall 10 lakhs. Incremental initial outflow is the upgradation cost of 10 lakhs. Fine. Sir, annual inflow. Sir, old machine, profit for every year is this. Old machine, depreciation is 0 because old machines book value is 0. So old machine profit 0, depreciation 0, CFAT also become, old machine profits are given, depreciation 0, which means this only become the CFAT of old. Of alternative 2, which is upgraded machine, what are the CFATs I will compare and then I will first calculate and then I will find incremental. Yes. So CFAT or PAT of the old machine are given. Of the new machine, PATs of the upgraded machines, PAT are given to me. Sir, what about depreciation? Additional 10 lakhs is to be depreciated over 5 years. So 2 lakh every year is the amount of depreciation and PAT and depreciation becomes CFAT. You get the CFAT of the upgraded machine. So as compared to old, option 1's CFAT. Alternative 2, which is upgrade, CFAT become this. So how much incremental CFAT we generate every year? This much. Multiplied with the present value factor give you present value of incremental cash inflow. For that 10 lakhs is being spent, so the NPV become negative. Extra that you have to spend is 10, but extra you will get every year in present value terms at 880. Don't spend extra, it's not worth it, negative, right? The objective was not to solve but to give you a sense of it, right? Perfect. Sir, in this question, how is it different from the previous question? In the previous question, what we had done, we talked about, so we know that revenue minus cost minus depreciation, right, give you PBT minus tax will give you CFAT plus depreciation. So option 1 is find incremental revenue, incremental cost, incremental debt. Option 2, find CFAT of this option, CFAT of this option, and ultimately calculate incremental CFAT. In the previous question, we calculated incremental debt, incremental cost, revenue, tax, etc, etc. So everything was incremental. Using all this incremental, I finally calculated incremental CFAT. Option 2, find the CFAT of both the alternatives and ultimately calculate the incremental CFATs. That depends on the data given. In the previous question, I was given incremental revenue, incremental cost, etc. So I had to calculate all the elements incremental. In this question, I have been given separate revenues and depreciation, etc. So I first calculated separate CFATs and then did incremental. Could I explain to you the point of difference in this question and the previous one? The main reason for doing this question in the class was this particular reason. Sir, if I update by the new machine, sir, original cost 20 lakhs 50,000. Fine, sir. Sale of old, I'll be able to sell at a price of 50, right? Since the book value is 0, I'll have to pay the capital gain tax. So on a value of 50,000, I'll have to pay a tax at the rate of 20%, 40%. So I'll receive only 30. So 2050 I buy the new, but 30 I receive from the old. So net amount blocked is 20 lakhs 20,000. So incremental here, nothing is blocked. If I use the old, no investment. If I sell the old and buy the new, then investment of 2020 net outflow. Fine. Sir, incremental, first the amount of depreciation now. Old, no depreciation, new. The total cost for new is 2050 divided by 5 years, give me 4,10,000 of depreciation every year. Incremental annual cash inflows. Existing machine PAT and CFAT are the same, but for the new machines PAT are this. With the effect of depreciation, CFAT become this. So how much is incremental CFAT of option 2 as compared to option 1? The incremental CFAT of every year are this. So extra you will have this inflow, right? The present value of which is 1747. But to get these extra inflow, today you have to spend 20 lakhs 20,000 as your extra outflow, and the NPV overall incremental is negative, which means you should not replace. Previously we said you should not upgrade. Conclusion was you should not upgrade. Now we say you should not replace because both the incremental NPVs are negative. Question 22nd people in the class gets done. One topic, 2 questions done. Boss, I'm now taking you to the next concept. The next concept is again extremely easy, which is optimal replacement cycle. They say, let me give an example. Suppose you can buy one of the 2 assets. Asset 1, asset 2. Both of these assets will generate same revenue. The only difference they have is one has a life of 3 years, another has a life of 2 years. Sir, I want to figure out which of the 2 assets is better. Using it for 3 years is better, or buying another asset, or in fact let me change the story. Let me explain to you the original story. I was trying to manipulate you by way of story and then come to the main concept. I feel you would be able to understand the main concept directly. Sir, I can buy a machine. Option 1, use that machine for 3 years, or option 2, use the same machine for 2 years. Sir, I have to incur the initial buying cost once. So initial cost is incurred same for both option 1 and option 2. Sir, to operate and maintain For 3 year the cost will be different, for 2 year the cost will be different. So whatever is the present value of all the cost for 3 and 2 year respectively, you do. Fine. Sir, at the end of third year when you sell, you have a different salvage value. At the end of second year when you sell, you have a different salvage value. So you do the present value of all the inflows and outflows associated to that particular machine. Buying it, operating it, maintaining it, running it, and in fact selling it. All the cost associated to machine, present value of that of 3 years and of 2 years you do. Can we compare the cost and say that the lower cost is a better cost? No. This is a higher cost, but obviously because the benefit taken is for 3 years, this is a lower cost, but in this case machine is used only for 2 years. I can't compare the two costs, they are not comparable. What do? We kind of average it out. You all might think, sir, divide by 3 and divide by 2, give me the per annum cost. You have to do the average, but with the effect of time value of money. You have to divide it with the present value annuity factor. So it is like if I have the present value of future annuities and if I divide with that the annuity factor of 3 year and 2 year respectively, will I be able to find out the amount of annuity of every year? Yes, dividing by 3 year annuity factor give me the cost, equivalent cost of every year. This also gives me the equivalent cost of every year, but for 2 years and here it is for 3 years. What have you done effectively? Sir, from the cost of buying to the operating to maintaining to selling, overall every inflow and outflow related to that asset considered, overall I tried to find out that when I do this machine for 3 years, when I use this machine for 3 years, how much will be the per annum cost of it? Per annum cost on an annualized basis, on an equalized basis, per annum cost of buying, operating, using the machine for 3 years, and similarly per annum cost of buying, operating, using, selling the machine for 2 years. And since they are per annum cost, now they are comparable and the lower is a better option. So you figure out for 3 year when you use machine, this is the cost. For 2 year if you use the same machine, this is the cost. So what is the better deal? To use it for 2 year and sell and buy new again, or use it for 3 years, sell and buy new again, is the choice you have to make. I hope I could explain to you this entire concept, right? Based on which will be the practical question. All these questions practically are really easy. Let's solve question number 23. An easy question of this category. 23 is easy. Let's solve question 25th, which is a more comprehensive question. 25th, let us everyone in the class solve, right? A machine used for the production line must be replaced every 4 years. I need to replace this at least every 4 years. If you want, you can replace it for 1 to 3. Depending upon cost for using it for how many years is the least, you make that choice. Cost incurred to run the machine is to purchase it at any point, it is 60,000. Whenever you purchase it, in the first year you have to spend 16 to maintain it, 0 year repair, and in the first year, and if you sell, 32 is what you receive. Sir, if you use it for second year also, second year you will have to spend 18,000 to maintain it, 4,000 for repairing, and you will be able to sell it for only 24, right? So can you feel, common sense, if you use the cost for 2 years, in the second year there is some extra cost being incurred of maintenance, and repair is also there. And more than that, the salvage value being received is also less. But what is the advantage of incurring these costs? That I am able to use it for 2 years, this is the advantage. So every year there is some additional cost which is there, loss of salvage which is there, but a benefit is that you are able to use it for 1 more year. So we have to evaluate that how much is the cost for every year. I'm trying to fit this question to the concept that we have learnt, if you all realize. Yes, sir, third year I have to incur this maintenance, repair, and salvage, this maintenance, repair. Let's assume that future replacement will be with the identical machine will have the same cost of 60 and same repairs and maintenance cost, sir, revenue remains unaffected. Whether you buy old, whether you buy new, continue to use old, revenue remains same. So you ignore the revenue, you work only on the cost. Lower cost is a better cost because revenue is assumed same. Sir, now you say, what should you do? You have to calculate the NPV. You have to calculate the equated annual cost 4 times. If I replace at the end of first year, initial cost to buy is 60. Fine, sir, the present value is also 60. If I replace at the end of first year maintenance is 16 outflow, 32 inflow, net 16 inflow. The present value of 16 inflow today is 13,913. So the overall, in present value terms, 60 go out to buy the machine, 13 come in from sale of machine, net number. Overall cost of using the machine for 1 year in present value terms is 46,086. Present value of all future in inflow associated to that machine. Sir, divided by the annuity factor of 1 year gives me at the end of first year, the cost of using the machine for 1 year is 52,997.24. 52,997.24. Yes. Now second, sir, in case of 2-year replacement cycle, initial cost you incur is 60. Fine, sir, present value 60. For first year you incur maintenance of 16. There is no salvage value, you didn't sell it. So the 16,000 of maintenance cost that you spent has present value of 13,913. In the third year, as in the second year, you will spend 18, you will spend 4, you will spend 22, but you will receive 24. So the net inflow of second year is 2,000 inflow, present value of which is 1,512. 2 outflows of year 1 and 2 and 1 inflow of year 3. Again, 2 outflows of year 0 and 1 and third inflow of year 2, right? Give me overall net present cost, net outflow of 72,401 in present value terms, which means buying, using and selling the machine for 2 years cost me 72,401 in total. Sir, let's divide it with the annuity factor of 2 years to find out how much is the annual cost of buying, operating and selling the machine for 2 years. The annual net cost is 44,535. So as compared to buying the machine for 1 year, it makes more sense to buy and use it for 2 years because per annum cost is lower. Similarly, you do it for 3 years, similarly you do it for 4 years, and you will realize that cost of buying, using and selling, the net cost of doing all this, the per annum net cost of doing all this, everyone in the class, is least if you use the machine for 3 years, which means replace every 3 years. The optimal replacement cycle is 3 years. Boss, could I convey you all a question on optimal replacement cycle, which is really an easy question. Same activity. When you replace it at the end of 4th year, in first year you incur this, second year you incur this, third year you incur this, 4th year you incur this, and you generate this. In first, second, third year there will be no salvage value generation because you are using it for 4 years. Yes. So that was the discussion on question number 25. Give me a minute. Just give me a minute. There is actually a typical question in this. I am not going to solve that question entirely for you. I am going to only explain that question to you. 21. Just explaining the question, right? It was not the plan of the original video, but just found that the question is really typical beyond what we have learned, which is why I'm discussing this question here in the class. You understand what's happening. They say that you have an existing machine now, right? Which can at max be there with you for a period of 4 years. Which means at the end of 4th year max, you will have to buy a new machine. But if you want, you can buy even 0 point first year, second year, third year, fourth year. You have 5 choices now in total, right? Question 1, should you buy the new machine or not? So we say when we observe. Just 1 second. Sorry, the question say when should we replace the new machine? So just explaining the solution and the question mixed combination, we are not doing it cut to cut. So we say the cost of new machine that I spend now is 90, right? The annual repair of that machine is 10,000 for 8 years. So the whatever future repairs I have to pay for that machine, present value is this. The salvage of the new machine at the end of 8th year is this, which means the life of the new machine is 8 years, right? So present value of all the outflows and inflows related to the new machine is 128. When I divide it with the annuity factor of 8 years, I get to know what is the per annum cost of buying, using and selling. What is the per annum net cost of buying, using and selling the machine? It turns out to be 28,600. This is what we have done. So what have we got to know? We have got to know that whenever we replace the machine, if we replace it at the end of 4th year, per annum cost will be this. If we replace it at the end of 3rd year, then per annum cost till the machine for the next 8 years, till the machine is alive for the next year is this. Whenever you replace, next 8 years cost is this. Fine sir, cool. Examiners say if you replace now, you will realize 40,000 from the old machine. If you replace after a year, then on the old machine, star tells you the point of replacement, right? If you replace at the end of 1st year, on the old machine you will first incur 10 and you will realize only 25 from the old machine, and the new machine every year cost has anyways been generalized. At the end of 2nd year, if you replace, 10,000 is the maintenance you will incur. 2nd year operation maintenance will be 20 and you will realize only 5, and similarly for 3 years, similarly for 4 years. Is the data clear? It is a combination of both the concepts that we have learned, whether I should replace or not, right? Which so it's I can say it's not a combination, but it's not a basic question of replacement that we have seen. It's like you have to replace, and when do you have to replace? The way institute has done it and the way we will also have to do it for the sake of marks is as it is. They are incorrect. They are absolutely correct. There can be other correct ways to present the solution or do the solution, which is fine, but we have to follow their solution. So what they have done is that they say that maximum possibility to replace the machine, old machine is 4 year. Sorry, maximum possibility is 4 year. So for 4 years, let's do total. Let's find out the total cost of buying, selling, running, operating both old and new machines, so we can know the total cost. For example, if I replace the machine now, I will receive 40. I will pay 28,600 on an equivalent basis for 4 years. It is the total cost of buying and selling and using the old and new machine, everything. Simple. If I replace the machine now, I will incur this, I will receive this, I will incur this, incur this, incur this. So for the next 4 years, the cost of buying, operating, running the old and new machine is this, the present value of all these amounts. Similarly, the present value of all these amounts. Similarly, the present value of all these amounts. That way, do you agree in all 5 alternatives? It is the total cost of 4 year. It is the total cost of 4 year related to buying, selling, operating old and new machine is considered, which is why all 5 alternatives are comparable to each other. The lowest alternative will be a preferable alternative is what I want to tell you. Sir, please understand, after 4 years, the per annum cost of buying, operating, using machine, the newer one remain the same, which is why that has not been made a part of decision making. Before 4 years, the cost for different situations may be different, which is why we have done it till 4 years. And for 4 years, since in all the scenario the time period is same, which is comparable. A student asked me, sir, why don't you calculate the total cost of 0 to 8 year in this case, 0 to 9 year in this case, 0 to 10 year in this case, and then divide by annuity factor of 8 year, 9 year, 10 year and so on to calculate the equivalent annual cost. That is also logical, but we have to follow what institute does. Institute divided through a line the time periods into this and this. After one is common for everyone. The per annum cost after 4 years is common for all the scenario. So let's compare the cost for the first 4 years. I hope I was able to convey to you the question, not solve it, but explain it in the manner that you all really find it doable. Was I to an extent successful to explain question 21? I mean, was it even worth it? Was it even worth it? Question 21, please tell me. Was it even worth it? So now I am going to take you. Come on, all the live people, please tell me. Now the last thing is real options. Let me tell you, real options actually does not belong to the chapter of advanced capital budgeting. They belong to the chapter of derivative. But they are related to something. They are related to not the shares or commodity. They are related to projects, the capital budgeting project. Things are relatable. You invest in a share, you earn dividend as cash flow. You invest in a capital budgeting project, you earn whatever cash flows from that project in the form of cash flow. So how do you value the real option? So only after you are clear with the concepts of derivative, which I have taken in the video of derivative, you can discuss this, in which we have to just understand two models, risk neutral model and binomial model. Yes. So let's take this situation one by one. Real option, for a moment I'll have to take you to the derivative for you to recollect what was the thought process. So the thought process is really simple. For the underlying asset, we know that there can be two possible prices, right? If the price become this and the price become this, what will be payoff from the call option or the put option? And depending upon what is the payoff and the probability of occurrence, I am able to calculate the benefit I will receive from the option. And present value of those expected payoff, present value of those expected benefit is the value of option today at 0 point. This is the broad story if you remember. The steps are really simple. First, draw the tree. Then calculate the future value factor to be used for the purpose of discounting, right? Then calculate the probability of occurrence, count it. Yes, someone says the OBS got disconnected. Is it the case, people? It got connected again. It got connected again. Just give me a second. Just give me a second. Yes. So what do we do? Perfect. So this is how you value the option. The same thought process is to be applied to a practical question we're gonna do. So let's solve in the class the capital budgeting question, people. Question number 30. So let's solve question number 30, a great question. What it says? It says that a firm is considering a proposal to set up cement manufacturing plant with an initial investment of 150 crores. Initially, how much will you have to invest? 150 crores. The firm has an option to abandon the project after 1 year by selling it to a competitor for 100 crores. Sir, today at 0 point, you invest 100 crore in a project, right? After a year, if you want, you can sell that project to a competitor. Sorry, today you invest 150 crore. If you want, you can sell that project to a competitor after a year for 100 crore. If the market conditions are favorable, demand is low, project's value will decline by 60%. However, if the market condition turns out to be favorable, demand is good, the project value will increase by 50%. At 0 point you make a 150 crore investment. This 150 crore investment after a year can become decline by 60 and increase by 50. So increase by 50 is 225, decline by 60 is 90 decline, which is leading to 60 crore value. So of the spot market, in the spot market, the value of underlying asset from 150 can change to 225 and 60. Are you able to relate it to the binomial? Fine, cool. Given the risk-free rate is 8%, value of option and value of project with put option with abandonment option. Sir, what do you mean by value of abandonment option? Listen to me. What is call option to buy the underlying asset? What is put option to sell the underlying asset at a particular value called as exercise price? Similar to that call put which we have learnt in derivative, this is also a call put that you learn here, which is nothing but option to sell the underlying asset, which is that entire project, after a year for a price of rupee 100 crore. That option you have. Price become 225 or price becomes 60. Today you have an option that after a year, if you want, you can sell this project to your competitor for 100 crore. That is an option you have. Do you agree? Option 2, abandon or sell the project, is nothing but a put option if you realize. I hope you have the clarity of call put. Call is an option to buy, put is an option to sell. So put, which is an option to sell, I have at a price of 100 crore. Do you feel 100 crore become my exercise price? So first of all, an asset in the next year, underlying asset, which in the next year, if it can become 225 and 60, despite the price of it in the market today is 150, then what are the probabilities? Apply risk neutral model. Sir, common sense, what it was? 225, suppose the probability of price of the underlying asset becoming 225 is P. Then the probability of price becoming 60 is nothing but 1 minus P. So 225 into P plus 60 into 1 minus P is the value of the asset after a year. So today what will be the value, the present value of it? So divided by 1.08, 8 being the risk-free rate for 1 year, sir, 8 being the risk-free rate, divide by 1.08, give me the value of an asset today, which I know is 150. So how much from this equation will be the probability of price going up and down? In the entire equation, only one number is missing, which is probability. So if you calculate, P becomes 61.82 and 1 minus P become 38.18. Yes, these are the probabilities of price becoming up and down. Now, if after a year, now think of the payoff. What was the sequence? First calculating the discounting rate 1.08. First drawing the decision tree, then calculating the risk-free rate factor, which is 1.08, then calculating probability, then calculating payoff. Option to sell at 100 rupee. If the value of the asset in the market become 225, will I sell? No. If the value of the asset in the market become 60, will I sell? In the market for 100, yes. How much is the payoff? 40. So do you agree it is because of that option you have, either you will earn 0 or you will earn 40, the probability of which is 61 and 38%. So whatever you are expected to earn from this option, what is the present value of it? So I am expected to earn 0 has 61% chance and 40 has 38% chance. And present value of those future earnings is 14.13 crores. So can I say the present value of expected payoff from the option, which is nothing but the value of that option itself, is 14.1389 crores, people. 14.1389 crores. Could I explain question number 30, the value of option? And the value of project with the option. The value of project with the option, there are two ways to think. Option 1, there are two ways to think. Way 1, if I buy the project today, right, without the, see, if the examiner asks me the value of project with the option, it means this is the value of the project excluding option. So right now I have a project. If I buy, I have to pay 150 crores. But at this point, in this price of 150 crore, I don't get an abandonment option. Whether the value of the project become 225 or 60, I cannot sell it at a price of 100 because option that I don't have right now. Right? If the price is 225, you'll have to sell it for 225. If the price is 60, you'll have to sell it at this price. Agreed? If you want to sell it for 100, irrespective of the price in the market, then you will have to also buy a put option and abandonment option along with the price of 150. In that case, how much amount will you pay? I will pay 150 to buy the project, and I will pay 14.1389 crore. I will pay 14.1389 crore to buy the put option. So the total value of the project along with put option become 150 plus 14.1389, it is 164.1389. There must be some rounding off error we are facing, but the logically answer should be 164, which is 150 plus 14.1389 is 164.1389. This is one way to think. Another way to think, sir, if the cash flow become 225, if the value of the asset become 225, I sell it for 225. If the value of the project becomes 60, with the option, I'll be able to sell the project for 100. Do you agree? With the option, the value of the project, the future cash flows from the project is 225 and 100. 225 with this probability, 100 with this probability, divide by 1.08 give me that the project is going to generate this and this value with the option included in it, because rather than 60 I'll be able to sell it for 100. It is due to the option only. So the present value of future payoff, when I do, it become 164.1389 something, right, as the overall value of project with the option included in it. Right? I've explained both the ways with clarity that how do you calculate the value of put option using risk neutral model. Now I'm going to teach you about the Black-Scholes model. Black-Scholes model. Again, this is something we have done in derivatives. That underlying asset has a spot price in the market. I have an option to buy that asset. Right? Nishal, you can do any of the two methods, but you should prefer to do the one by ICI, which is there in the outscanner. Simple. Okay? Sir, underlying asset has a spot price. Underlying asset has a spot exercise price. So similarly, project has a spot price. Project has a spot price, and project has an exercise price at which we can buy the project. Perfect. Sir, log natural of spot divided by exercise. Black-Scholes is all about formulas. I'm not getting into the details of it again because we have done it in derivatives. Fine. Sir, rate of risk-free rate plus SD square by 240 time period divided by this give you D1. Similarly, you calculate D2. And for this one, D1 and D2, which are my Z values, I calculate the area from the probability distribution table, calling them ND1 and D2. And accordingly, I apply Black-Scholes model. This particular part will differ a bit, which I will explain to you. Let me go to that particular practical question. Question number 31, people in the class right now, please. Just give me a minute, let me have water, then we all continue. The last question for the day, by the way. Perfect. So come on. Let's start to read the question. Let me tell you the question from Black-Scholes you find typical. Why? Because the concept itself has a formula. Second, we have only one particular question to practice. Should we do, sir, more such questions for the sake of practice? My suggestion would be no. Based on my observation of institute's question paper, generally saying, institute asks you a repeated question of this type. Now when institute asks you new question, that is something you can't predict today, that what kind of question it's gonna ask. So even if you do along with this two other variety of question on this, institute might ask you that third variety that you have not covered. So when it comes to a seen question, this is the question institute may ask. But when it comes to an unseen question, then we can't predict what kind of unseen question institute may ask, which is why we cannot prepare today for that unseen question. Getting it? With that too with a situation which is less probable for exam. So let's see what happens. Sir, for now it's needed only to cover this particular question for you to give you a sense of how do you apply the Black-Scholes model to the real world option. Why do you call it real option? Because an option to buy or sell not a particular share but a real world asset, the project itself. So come on. ABC Pharma Company possessing a patent right of a drug called Adrex, a medicine for AIDS patient. Being an approach drug, ABC holds a right to product to drug in its marketing. So please understand what's happening. The situation, the context I'll have to make you clear, else it's difficult to grab. I have a patent, which means only I can manufacture it. Can you feel? I have an option. Basically, patent is what? Option to manufacture something, option to invest in a project, option to buy a project, correct? That patent gives me an option to buy the project. The period of patent is 15 years, after which other pharma company can also does it. For the next 15 years, I have the option. It is estimated that company shall require 12.5 million for develop and market of the drug. Today, what is the cost at which I can buy this project, I can invest in this project, I can own this project? 12.5 million become my exercise price, right? One second. Cool. As per survey conducted, the expected present value of cash flows from the sale of drug during the next 15 years shall be 16.7. Over the next 15 years, when I sell those drugs, I will generate cash flow. So the present value of all those future cash flow is 16.7 million. Can I say value of an asset today is the present value of future cash flow? So 16.7, which is the present value of future cash flow, is nothing but the value of asset today itself, calling it to be the spot market price, spot price of the underlying asset as 0, which is the present value of cash inflow. So an asset whose present value in the market today is 16.7, the same asset I can buy at 12.5 million, because I know that investment needed to own that project, to start that project, is only 12.5 million. Cool. If you read the question only till here, you will feel the value of option is difference between the two. Meaning to say, something which has got a value of 16.7 million today, that particular thing I can get by investing only 12.5 due to the patent. So due to the patent, I could buy at a price of 12.5 whose value is higher. So how much value that patent has, how much benefit or advantage that patent is giving to me, the difference between the two price, you might think. But cash flow of similar type of project exhibited variance of 28.6, meaning to say you will generate 16.7 is not fixed. It is subject to risk. You might generate less, you might generate more. Sir, that is the problem. Sir, the current yield on treasury bond is risk-free rate is 7.8% given the log natural value and e raised to rt value and end even d2 values. Find the what you have to find? Value of patent, value of option. Sir, I have an option to start the project whose value expected is 16.7. If the value in the market is more, because this is an expect value, in reality it can be more, in reality it can be less. If it is more, it is good to me, because something which is of 18 million, I'll be able to do it for 12.5. But if the value is less, suppose 10 million. So something which is going to be of 10 million, I can do it for 12.5. I can buy that asset for 12.5. Will you buy that asset? No. Which means in that case, the value of an option becomes 0. Correct? So that's why I cannot directly say the difference between the two values is the value of an option, because this is an expected value. Right? What do we have to do? We have to apply Black-Scholes model, which has some, point of additional learning as compared to the Black-Scholes and derivative. Learning number 1. Sir, first is ambiguity by the institute. Cash flows from previous similar type of drug have exhibited a variance of 26.8% of the present value of cash flows. Right? In the future year, if we compare the cash flows variance fluctuation, it is 26.8% fluctuation of the present value. Whatever is the present value, how much it is? 16.7. So 26.8% is the variance, right? Do I need the variance in the formula? Yes, sir, I need the variance in the formula. Only problem is that variance which is given to me in percentage terms, I have taught it to you in the portfolio management that convert the variance from percentage to decimal, you have to divide it with 100 square or 10,000. But institute unfortunately have divided it only by 100. So even if ideally 26.8% in decimal terms 0.00268, institute has considered only 0.268, divided it by 100, it is the ambiguity. And I'm expecting that we will have to do unfortunately the same thing in the exam. First thing. Second, rate of return is find. Sir, third, when you invest in the share, you receive dividend every year, which is the income, right? Similarly, when you invest in a project, you receive people in the class cash flows every year. That is also income on that project. So it is a kind of dividend you receive every year. In other words, we have to say that we have been given the amount of dividend yield on the amount of investment today, on my spot price, on the market price of the share, on the market price of the project. The cash flow that you receive, the dividend that you receive is called as dividend yield, and the treatment of it, people in the class, is really simple. R plus sigma square, which is variance divided by 2 to the power t. When we do, rather than this, you will have to now do R minus y. R, rate of interest. Y, the amount of dividend yield. Sir, how do we get to know the amount of dividend yield? Common sense. 16.7 is the value you will receive every year over a period of 15 years. So every year, how much cash flow will you receive? 1.1133. In yield, how much is the yield? So dividend per year is this. On the spot price today of 16.7 per annum, dividend yield is 6.67%. This also has a little of ambiguity, but I don't want to explain it now, because anyways in the exam we will have to do the question in the same way. Perfect. Sir, what was the formula? Formula was log natural of spot divided by exercise price plus R minus Y plus variance divided by 2 into the time period divided by standard deviation into under root of time. Let's look at the parameters one by one. Do I have the spot price? Yes. The value of the underlying asset 16.7. Do I have the exercise price? Option to buy the same project today only at a price of 12.5. Yes. 16.7 divided by 12.5 log natural. R is 7.8 minus dividend yield of 6.67 plus variance, which has an ambiguity, divided by 2 into the 15, which is time period, whole divided by under root of 0.268, right? Because given number is a variance, so I have to divide it with the standard deviation, which is by under root, and t, the time period, is anyways in the under root. When you solve it, this is scam unfortunately, but we'll have to follow it. Because please feel the common sense. When 0.268, when 26.8 is the variance in percentage terms, how much is the standard deviation? 5.17% obviously. But unfortunately, Institute did convert it to what? Institute did convert it to the decimal. Now 0.268, when you considered variance, 0.268, the under root of it is 0.517. Correct? When you convert it to percentage terms, it, people in the class, turns out to be 51% unfortunately as SD. Whereas in actual world, SD is 5.17, not 51.7. Are you realizing? But unfortunately, with this ambiguity, I'm really sorry, you have to mug up the question by writing it down twice, but solve it as it is. Sir, under root of variance is SD multiplied by under root of time. When you solve this, you see that 16.7 divided by 12.5 is 1.336 as the log natural, whose value has been given 2.897. So this value given, this value is solvable, this value is solvable, give me 1.2315 as D1. Has I been given the value of D1? Yes, it will be given in the question. So area is 89.10. So basically 89.10% is the probability, is the area. Similarly, D1 minus the denominator give me D2 is 0.7735, the area of which is 21.96, even that is fine. Now coming to the value of patent. So patent is nothing but the call option. Call option, the option to start or buy the project today by investing only 12.5, whose value in the market is 16.7, which is expected, not actual. It may be more, it may be less, which is why we are doing all these efforts. Fine, cool. How do? You have a simple modification here. Sir, let me modify this for you. Yeah, the formula is spot price divided by the, you remember we used to do e raised to RT to calculate the present value. Similarly, rather than RT, we will have to do e raised to YT. Sir, we have to eliminate the effect of dividend from the spot price. You remember eliminating the effect of dividend from the spot price, which should not be new for you, because in the Black-Scholes model, in the topic of derivative, we said use the formula which is X dividend. Use X dividend spot price. So sir, spot price divided by e raised to YT into ND1 minus present value of exercise price, you anyways do exercise price divided by e raised to RT into ND2, right? Let me check if this solution is there in the handmade notes or not, because I cannot, wait. Yes, this is what I want to tell you. This is what I want to show you. Fine, perfect. So we have ND1 as 0.8910 and ND2 as 0.2196. So spot price of 16.7 divided by e raised to y, which is 0.00667 into t is 15, multiplied by ND1 divided by minus exercise price divided by e raised to r of 7.8 into 15t into ND2. Perfect. This equation when you solve, because e raised to RT values are given to you, when you solve the equation, you get the value of $4.6192, which is the value of call option, the value of patent, because that patent gives you a right to start a business at 12.5, whose value in the market is 16.7. Yes, yes, yes. People, are you all able to understand? It is applying the Black-Scholes formula with minor modifications. What are the modifications? Modification number 1. You have to calculate the yield for the purpose of formula, for the purpose of D1, calling it to be the dividend yield. Modification number 2, that yield is to be deducted from the rate. So R minus Y is the formula you will have to apply. Modification number 3, spot price will also have to be divided with e raised to yt, where rest everything else remain the same as we have learnt in derivatives, and ambiguity is converting the variance into decimal just by dividing it by 100. And important point was to be able to understand what is the spot price and what is the exercise value. Spot price is the value of asset today, which is present value of future cash flow, where exercise price is the price at which I can buy it. I can start the project. That was all, people, in the class on question number 31, which is valuing a call option using Black-Scholes model. So we have done one question of each type, even in the real options. Yes. So I hope the entire discussion that we have done on the chapter of advanced capital budgeting decision is really clear. I have tried my best to explain everything with whatever best clarity I could deliver, the question, the concepts, everything. If you have really liked the video, if you're watching it so far, please make sure you put down your genuine comments in the comment section of this video. Yes? So thank you so much, people, for watching it up. Let's meet back again in the next video. I hope the video was really helpful. If it was, kindly share it with your juniors. Yes? So bye live people, thank you so much for being here. Nishal, bye bye. Other live people, recorded people, thank you so much for watching it up. Let's meet back again, and all the very best for the exams. See you.